Good morning, everyone. I'd like to welcome staff and board members and those joining us virtually to the November 20th Investment Advisory Committee. I'd like to call this meeting to order. We'll start with our joining me in our Pledge of Allegiance and our salute to the North Carolina flag. Pledge allegiance to the flag of the United States of America, to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Salute the flag of North Carolina, and pledge to the old North State, love, loyalty, and faith. Thank you all. We'll now call the roll to determine the quorum.
All right. Good morning, everyone. My name is Jason Sass, and I serve as Deputy General Counsel at the North Carolina Department of State Treasurer. First, I'll take a roll call of the committee members to confirm we have quorum. Then I'll go over a couple of reminders for our public meetings. For the roll call, Mr. John Annarella. Here. Mr. Lance Brewer.
Here. Good morning.
Mr. Loris Coakley. Here. Mr. Michael Mevin.
Here. Can you hear me?
Yes, thank you. Mr. Greg Patterson.
Here, sir.
Treasurer Falwell.
Here.
And we have a quorum. So thank you, committee members, for your patience. Here are some quick reminders for our public meetings. For those who have called in, please remember to mute your phone when you are not speaking. Please state your name when making or seconding a motion. If you need to leave the meeting, please speak up to let us all know. And if you rejoin, please identify yourself. For anything that this committee votes on, the votes will all be by roll call. We'll deem the members who make the motion and second it as voting yes. Finally, a reminder to anyone speaking from the audience during this meeting, please remember to stand and clearly state your name, title, and organization for the record before proceeding to speak or answer a question. Today's meeting agenda is posted for public availability on the Department of State Treasurer's website at the Investment Management Division page. If we lose the phone line connection altogether, the meeting will be deemed to be in recess, and we will put a notice on the nctreasurer.com website homepage when we have information about a time to resume the meeting. Are there any questions about these procedures? Thank you very much. At this time, I'll turn the meeting back to the chair for approval of the last meeting's minutes.
Thank you. Without objection, anybody who makes a motion or second to a motion will be considered a yes vote. Hearing no objection, do I hear a motion to approve the meeting minutes of August 28th?
I move approval.
Thank you.
Second.
Motion second being made. Any further discussion? Hearing none, the clerk will call the roll.
For the roll call, Mr. Annarella?
Aye.
Mr. Brewer?
Aye.
Mr. Nevin? Treasurer Falwell?
Aye.
And we have
aye.
approval. We have unanimous approval.
Thank you. We'll now turn over to our co-chief investment officers, Jeff Smith, Christopher Morris.
Treasurer, if I may, I'd like to ask these gentlemen if they dressed out of the same closet this morning.
Fairly close, yeah.
Same size.
Wait till Brett and I go with fixed income. I think we have different colors but the same patterns on the ties.
Opposite closets.
Same size too, right?
Yeah, we wish. Some of us wish. Okay, we'll hop right in a little bit. First thing, I'll give us a couple comments on the third quarter, and really, as I was taking a look at things, I think if I had to put a theme on it, it was, are we there yet? At the start of the quarter, like you had your kids in the car and keep asking, are we there? And really, as that relates to the Fed actions, and the market really entered the quarter waiting for that all clear on inflation, so that they can take action. Sure.
Gosh, I've done this every time, but this time. I want to welcome Representative-elect Brad Briner. Many of you have met, Treasurer-elect, excuse me. That'd be a caucus meeting last night, so I've been talking to representatives all morning. Treasurer-elect Brad Briner, welcome. And as we have talked about in the past, I have a whole plan for a transition team, and this is part of it. And so I want to welcome you. Thank you so much. Sorry.
No, no problem at all. You almost got another roll there.
Almost did. I didn't want.
You may need that one.
So the August, there was some panic as unemployment spiked to a level that wasn't seen since 2021. And that did prompt a material sell-off for one day, but in the following weeks, the data really calmed those fears down. And by month end, we had Chairman Powell signaling at Jackson Hole that the time had come. And the announcement fueled the markets throughout the rest of the quarter. And then finally on September 18th, we got the first rate cut in 4 years. But I would say as they cut, they didn't really bring the paring knife for 25. They brought the big butcher knife and cut with a 50 basis point cut. So, politics, obviously a huge part of the news cycle during the quarter. We had a change in the Democratic candidate, really throwing the presidential race into chaos, among other things. And we'll talk a little bit about some data later on about even post this quarter. On the equities front, strong quarter with really notable changes in sector performance, though. We saw large tech and energy struggling, which had really been leading in the past. Small and mid caps outperforming large caps, value outpacing growth, and international markets generally outperforming the domestic market. I won't spend too much time on fixed income since that's a focus of the later presentation, but we did see strong returns driven by falling yields from the Fed actions and moderating inflation concerns. Treasury yields down as much as 100 basis points on the front end of the curve, down roughly mid-40s on the long end. Corporate spreads a little tighter over the last quarter, despite a little bit of a spike in August when we got that unemployment read. On that. So that's a quick look at it, and with that, I'll turn it over to Chris.
Good morning, everybody.
Good morning.
Turning to the portfolio on slide 7 of the deck. Total assets under management for the investments division as of September 30th was $193.8 billion, which was up $7.5 billion for the quarter and up about $12.6 billion calendar year to date. This is another new all-time high in terms of total AUM for the division. The majority of the increase was due to the appreciation of NCRS assets as markets rallied and drove total plan returns. NCRS was up about $5.6 billion for the quarter, and it's up close to $10 billion calendar year to date through the end of September. The other pools of capital increased as well for the quarter, with the cash management program up about $900 million. Supplemental plans were up about $1 billion. And the ancillary funds were up about $180 million, all really driven by strong markets. Moving on to slide 8. This gives a snapshot of the NCRS asset allocation as of September 30th. The portfolio ended the quarter at $128.6 billion, up from $123 billion at the end of Q2. This is another new high water mark in terms of market value for the plan. The growth underweight decreased this quarter from about 1.9% to 1.4% as growth assets outperformed other portfolios. Public equity is overweight by 3.1%, while private equity, non-core real estate, and opportunistic fixed income continue to be underweight the long-term targets. Rates and liquidity continues to remain overweight, although that overweight decreased from about 2.2% at the end of Q2 to 1.8% during at the end of Q3. With all of that overweight driven by pension cash. The inflation-sensitive and diversified portfolio is about 1.5% underweight. All of that driven by the inflation-sensitive portfolio, with core real estate being flat, right at target. Multi-strategy continues its modest 1% overweight to its 1% target. The next slide shows a more recent snapshot of the same asset allocation. Market value is down slightly. This was about a week ago, so things have changed a little bit since then. But market value is down slightly since the highs at the end of Q3, as we've seen a good amount of market volatility the past 6 weeks. No major changes in allocation since quarter end. The portfolio is slightly less underweight growth and slightly less overweight rates and liquidity as market movements are pushing the portfolio closer to its long-term targets. Moving on to the next slide. This is the portfolio return net of all fees versus its two main benchmarks. Q3 was a very strong quarter with the portfolio up 4.8%. Both public equity markets and bond markets drove the strong return, with public equity earning more than 7% and core fixed income up more than 5%. For the 1 year, the portfolio is up 16.25%, again driven mainly by strong equity markets, which returned more than 31% for the 1 year period. The 3 and 5 year time periods are at 3.3 and 6.4% respectively, with longer time periods hovering between 6 and 6.5, with the exception of the 15-year, which is at 7.1%. Relative performance for the quarter was slightly negative versus the implementation benchmark and behind the long-term policy bench by about 1%, again, as global equity markets outpaced all other asset classes. The 1 year lagged both benchmarks as a combination of allocation and selection effect drove the underperformance. We'll see that a little bit later in the attribution. Longer time periods are still close to or exceeding both benchmarks. And looking at Q4, portfolio is down about 1.5% quarter to date. As I mentioned, we've seen a good amount of market volatility, both pre and post election. Calendar year to date, the portfolio is up about 7.3%. So no questions, move on to the next slide, slide 11. So this is the strategy breakout slide, the sunburst chart that I think we put in last time. This just shows a different way of kind of viewing the portfolio. The blue is looking at the growth assets, yellow is rates and liquidity, the green is the inflation sensitive and the diversifiers, and the orange is the multi-strategy. The table on the left shows the number of managers and active funds per asset class. And by active funds, it's not active versus passive, it's active versus inactive, essentially. So just the number of actual individual investment mandates that we have. So this kind of just shows the complexity of the portfolio's hierarchy and the plan's 280 or so individual mandates that we have. And then from a strictly size perspective, I think this is a good chart to see. You can see the largest drivers of the portfolio are really core fixed income in the rates and liquidity, as well as the internal Russell 1000 passive mandate that we have in the growth bucket. Those two individual mandates, account for about $55 billion in assets, or 43% of the portfolio. So you can see just from a pure size perspective, those two have a very large impact on how the portfolio as a whole performs. Moving on to the next slide. So this is the geographical and sector exposures for the portfolio. The left chart shows geographical exposures. While most asset classes do invest globally across the world, you can see that about 74% of the assets are domiciled in the U.S. So we still have a pretty large home country bias for the portfolio as a whole. The right chart shows exposure by sector, very diversified portfolio across sectors with technology, financials, and government securities leading the way. Moving on to the next slide, growth of a dollar chart. This doesn't change much from quarter to quarter. It just shows over the long term how the portfolio has grown compared to both the implementation benchmark and the long-term policy benchmark. And then on the top right there, on the end of the chart there, it's hard to see, but the total pension is slightly ahead of the implementation benchmark and a little bit more ahead of the long-term policy benchmark. So obviously that's what we want to see over the long term is that orange line exceeding both the other lines.
I think we've said it periodically, but this question will come up is like, why did it start at 97 on this chart? And that goes back to that's when we went mark to market valuation, total return on fixed income. So we didn't have that to blend before that time period. So
yes, because I'm sure a lot of you know the pension began in the early 40s, but we just didn't have a total plan return until 97. So.
When did you start, Jeff?
I started in 91.
Early 40s.
So supposedly the former treasurer, before there was mark to market, he had RJ Reynolds stock when it was getting LBO'd by Ross Johnson on the books at $1 a share, because he did not want the General Assembly to know how much money was in the pension plan. But that's just a wild rumor, but I think it's pretty accurate. Is that pretty accurate?
That's my understanding, yes.
Okay.
Well stated.
LBO was $150 a share, I think, or something like that. Anyway.
I'm moving on to slide 14. So this is another snapshot of the growth of a dollar
People
chart.
can look up who Ross Johnson is another time.
So slide 14 shows just two different time periods, snapshot of the same growth of a dollar chart, looking at the total pension, the long-term policy benchmark, as well as our total alternatives composite. You can see in the 5-year, The long-term policy is slightly ahead of both the alternatives and the pension. But on the 10-year, you can see that the total pension is ahead of the long-term policy benchmark, and the total alternatives is ahead of both of those. So it kind of gives you a quick snapshot of the additive value of that alternatives composite over that time period. The next slide shows the contribution to total plan return for the 1-year time period ending September 30. This shows how each asset class contributed to the return and subsequently the earnings for the plan for that 1-year time period. So the 16.25% return for the total plan, that equates to about $19.5 billion in earnings. And you can see that public equity was the largest driver of that, given the size of the equity plan, as well as the very, very strong returns for that 1-year time period. So the equity portfolio, accounts for about 70% of the returns and subsequent earnings for the plan over that time period. We did see strong returns from IG Fixed as well in that time period. You can see there second in terms of the contribution to the total plan return. Moving on.
Just a quick question on the real estate. Like in the public markets, there was a pretty good rally in REITs and so forth. Is there a delay, do you think, in these results?
Yeah, well, so the public REIT portfolio, we have about 20% of our core real estate in REITs, and that performed very, very well. But the privates lagged, and we still saw the decline in appreciation of assets, or I guess in depreciation of assets for the real estate portfolio throughout last year. So we're starting to see that turn around. But yeah, there's definitely a lag between the private and the public in real estate historically. So we would expect that to turn around, and we're starting to see that now turn around.
Is real estate here?
Yeah, Troy will be here. He had to.
Just leave it there
before
for now. That's right.
conflict. Yeah, Troy will be here in a minute, but.
We're wearing blue and red ties. So all right, go ahead. Good question, Tom.
So moving on to the attribution slide, slide 16. So this shows the net of fees attribution for the 1- and 3-year time period. Similar story for both of these time periods where the portfolio underperformed the implementation benchmark by 44 basis points for the 1 year and by 9 basis points for the 3-year time period, with the underperformance driven mainly by selection effect for both these time periods, as some of the individual asset classes struggled to keep up with the benchmarks. And you can see on the right side of those charts there. Allocation effect was positive for both the 1- and the 3-year time period, as the overweight to cash did add some value for specifically the 3-year time period. If you're looking at the slide 17, which show the longer term time periods, a bit of a different story there. You can see that for the 5-year time period, the portfolio underperformed by about 31 basis points, but did add value over the 10-year by 16 basis points. And this was driven, the negative returns, relative returns, are driven by allocation effect for both these time periods, as the overweight to cash and underweight to public equity negatively affected the relative returns. But the selection effect was positive for both of these time periods, where the outperformance of the asset class in aggregate added value from a relative perspective. What I think is good to see is on the 10-year, on the bottom right there, you can see the selection effect, and then where pretty much every asset class, with the exception of cash, which had a 1 basis point lag, every asset class was at or exceeded benchmarks for that 10-year time period. So that's certainly something we'd like to see.
Can I just ask a quick question on the weights here on the 10-year? I'm guessing that's actually cash that's so overweight, not core real estate.
Yeah, it should be. It must have. Yeah, that must be an error. Yeah, that's strange. Yes, core real estate's definitely not overweight. Yeah, it was cash. Yeah, yeah. I think that must have just been a label.
No, I'm good. Thanks.
I'm not sure which would have been better.
I think you got it right, relative.
Moving on to slide 18. So this just shows various risk metrics that we take a look at. I guess what's notable here is we talk about volatility, the total plan in the top left. We've seen that come down for the 1-year time period, which is the blue line there. But we've seen in aggregate higher volatility. We've talked about this previously since COVID hit in 2020. We've seen higher volatility in the markets versus a very low volatility environment for the 2010s, for most of the 2010s, especially the later half of that. So you see over the long term, the 3 and the 5 year, the orange and the gray line there, you saw that the volatility was down to about 4% back in 2019-ish. But that you've seen trend up pretty significantly to be about 8% now, which is long-term since 97, since we've been able to start tracking this. Our long-term average is at roughly 6%. So you've seen that the trend the last 4 or 5 years has certainly been to a more volatile environment. And I think a lot of that is we've seen volatile environments for equities fairly frequently, but what we saw in the bond market really in 22 time period was pretty significant from a volatility perspective, and we saw those huge negative returns in bonds, which we hadn't really ever seen. So I think that drove a lot of it from a total plan perspective as well. But we've definitely seen kind of the portfolio move into a different sort of tier in terms of volatility. And then from a tracking error perspective, in the top right, you see that that's been trending down really the last couple of years. A lot of that has to do with when we did the asset liability study in 22 and we changed some of the targets. We've been managing the portfolio closer to those new targets. So you'll naturally see the tracking error trend down, which is what you see. Really on the 1 year, you can see it significantly. And then on the 3 year, you can see you can see that kind of took a turn at 22 and into 2023. So moving on, not much to hit on the next slide. I'm going to skip that one. This is just the downside capture. We haven't really been in a drawdown environment recently, which is a good thing. So not really much story change from quarter to quarter there. Slide 20 goes into our universe comparison. So this is compared to U.S. public funds greater than 20 billion, which is in the BNY Mellon universe. And all this data is gross of fees, which is how BNY Mellon tracks it. So that's how we have to compare ourselves to. You'll see for the 1 year time period about 16.5% gross return. That was close to median in terms of our peers are at the 54th percentile. Same with risk, close to median in terms of risk for the 1 year. And I think a lot of that had to do with both positive returns from equities and bonds. So we saw pretty good, obviously very strong returns, absolute returns for that time period. And then on the longer term time periods, you see from both a return and a risk perspective, we're in the lower quartile. We've talked about that a lot. Very low risk profile, which tends to lead to lower returns over the long term. So no real surprises from that. Moving on to the next chart, this is just the same chart with showing it with Sharpe ratio. So Sharpe ratio is a measure of risk-adjusted return. So it basically takes into account both the returns and the risk. So you can see over the shorter time period, we've been in the bottom quartile. A lot of that has to do with the volatility we saw in the bond market fairly recently. And then over the long-term time frames, we've seen that trend closer to median. Moving on to slide 22. This one, we don't update quarter to quarter. No real changes from this. This just really shows how we sit. So the other piece of that, how we sit versus peers. We'll try to update this shortly. This data is a little bit stale, but this doesn't change dramatically from year to year either. Where the NCRS is typically very highly ranked in terms of funded status, which is kind of one of the key factors when you're looking at how risky do we want the plan to be, how much risk we want to take in a portfolio. Fortunately, we've been very blessed to have the General Assembly fund the plan consistently over time, which really helps out with this funded status. A lot of our peers that have gotten into trouble over time is really due to that, the not having support from the legislature. So that's been a key component of maintaining this well-funded status that we've had for a long time. So this just shows where we kind of sit there, and also that chart shows where our assumed rate of return is versus some of our peers, because that's also drives what the funded status calculation is. So if we have a lower funded status, a lower assumed rate of return, the funded status compared to peers with a higher assumed rate of return will be different, will be lower essentially. So most of our peers still have a higher assumed rate of return. And you can see on the chart there, only South Dakota had the same assumed rate of return as us. All the others had a higher actuarial assumed rate of return. So that's another piece when you're kind of comparing plans. You have to take kind of all that into consideration.
Yeah, that from time to time I get asked about this when I'm around other treasurers and other kinds of folks, and I suggest that this is something they should do, and they said, why would I do that? It's going to make me look worse. So, but it was the right thing to do, and I appreciate the teachers board and the elders board stepping up to the plate and doing this 4 times years ago, and the rating agencies also appreciate it because it's them, and I guess one of our consultants have been recommending this take place for at least a decade or 2. So anyway, I'm glad that there's only one state that has a higher funded ratio that has an assumed rate of return equal to ours.
Great. Moving on to slide 23. So this is the liquidity profile for the portfolio. The left side shows the liquidity allocation in dollar terms. The right side shows it in percentages. So if you look, for example, at the top right of the chart, you can see public equity is the most liquid asset class with mostly what we call level 1 liquidity. These are our definitions for liquidity, but we just wanted to get a good sense from tiers in terms of how we could access capital if we needed to. So we define each one of our individual mandates in terms of, we bucket them in terms of level 1 through 4. From a liquidity perspective. So you can see really like the top of public equity, most of that is level 1 liquidity. And you can see obviously investment grade fixed income cash, that'd be level 1. And then as a total portfolio, our policy guideline is to have a minimum of 70% liquidity, level 1 liquidity, sorry. And we're currently at about 77%. So we have a lot of liquidity in the portfolio as a whole.
This is liquidity at the vehicle.
The vehicle level.
Security level.
Yes, the vehicle. Every vehicle we categorize as that. Obviously, public equities is typically level 1 anyways, anything markets, but yes, it's at the vehicle level. Moving on to slide 24. This shows the net benefit payments by calendar year. So again, this isn't gross benefit payments, which continues to go up. This is net, which is coming out of the portfolio. So structurally how that works is monthly we get essentially a bill from Financial Operations Division, which projects how much cash they're going to need on a net basis for the following month. So we pay monthly anywhere between 100 and 300 million a month, depending on what's needed for that particular month. By policy, we want to have under 3% annually leave the plan. And you can see the dotted lines, that 3%, the solid orange lines, what it's been the last several years. So a couple of factors in that number, nosediving a bit, which is a good thing from a portfolio management perspective, is that obviously the assets have increased pretty significantly. So you got the denominator effect there where the portfolio has gone from 87, 88 billion in 2016 to 123 billion now. But we've also had net money coming out of the plan reduce over the last several years, mainly due to the pre-funding policy that the board has in place, what they call the ECRIS policy. So that's really helped out as well from a net leaving the investment portfolio perspective. So that's really what's driven those two numbers. But yeah, you can see that it's come down pretty significantly, which, certainly good from a portfolio management perspective, less money leaving the plan, more to grow, right?
Yeah, I mean, Chris, I remember, 10 years ago now that I'm reminiscing about stuff, and that this chart was supposed to go all the way up to the right.
Yeah, and again, the gross payments not going down. It was just the net. So I think it's, I I mean, it's been a good, again, from a portfolio management, from an investor perspective, it's been a very good policy to pre-fund that, and it certainly helps everything, right? But again, there's obviously challenges on the other side of that too.
You said 123 billion. Did you mean 127?
Yeah, it's currently, 128, at the end of September. Yeah, it's 123 at the end of June.
Yeah. To John's point, this graph up here just always befuddles me a little bit because I know there's less people paying in the plan than are not. And we are paying out $7 billion a year in gross benefits, and that's going up. So anyway.
Yeah, I mean, we would expect that to change at some point. But yeah, we've seen it trend up over the last several years.
And for treasurer-elect purposes, the General Assembly brought back layaway. So when they pay out a supplement to the retirees, they don't pay us. They pay us in installments, even though we pay it all out in one day. So if you see one of these, it's because.
Yes, yeah, exactly. Yeah, they've done that.
Color on that.
Yeah, sure. They've done that the last couple of years where they give one-time supplements to the retirees. So that usually hits in one lump sum in like October, somewhere around there. So they pull it all out of the portfolio in one lump sum and then they pay it back essentially over time. So we'll see one lump sum of $400 million coming out 1 month and then lower amounts leaving the portfolio in the next 6 months after that. So it's just more of a cash management issue short term. So.
The current ECRIS policy is set to expire in 2 years.
I believe is it next year? You know, Sam, I'm trying to remember. They either vote on it next year or the year after.
Sam Watts, legislative liaison. We generally will discuss the ECRIS policy during the experience review with the retirement board, but during next year or the reset next year. So your timeline they're pretty spot on with the conversation on whether to reset and how to reset is coming up very shortly.
Sure.
But, credit to this staff and I guess Treasurer Cowell and Sam who put this in place, right? This is pre-Dale.
Great. Moving on to the next slide. Another slice of look at liquidity. This takes a look at kind of our alternatives, cash flows for the prior 12 months. So on an aggregate basis, which you can see on the top right there, we've been pretty cash flow neutral with slightly more money leaving the plan than coming in to the tune of about $20 million. So it's been basically cash flow neutral for the last several quarters where we had been cash flow positive for multiple years prior to that. So we've got back to, I think it's a combination of some of the things we've done have had larger checks that we've had to send out, as well as the distributions that we've seen come in have decreased this calendar year, really. So it's kind of a combination of the two where we saw that get back to a neutral status for the prior 12 months. But you can just kind of see for each asset class and then in aggregate, you can see kind of where we've been. No questions on that. I'll move to the last slide I'll hit, and I'll turn it back over to Jeff. So this slide 26, looks at our valuation lag. This slide takes a look per asset class and for the total portfolio, how frequently the individual mandates, individual securities are valued, right? So most of the public markets, that stuff all gets valued daily. Some of the hedge fund type structures that we are in get valued monthly, and then a lot of the illiquid assets, the private equity, some of the real estate that gets valued quarterly. So you can see for an asset class perspective where those sit, and then on the bottom you can see as a whole where that sits. So about 76% of the portfolio is valued daily. About another 9% is valued monthly, whether it's with no lag or 1 month lag, depending on the vehicle. And then about 15% is in those illiquid kind of quarterly valued structures that get valued quarterly on usually a 45-day lag. So you can see, a big chunk of the portfolio is valued at least monthly. More than 85% of the portfolio is valued at least monthly. So if there's no questions there, I'll turn it back over to Jeff to
Take us on there.
slides.
Thank you, Chris.
All right, so on slide 27, a lot of data on here, but really focusing on the performance net of fees of the asset classes. I'll walk you through a couple of different observations. So on the 1 year front, we talked a lot about the strength in public equities, 31%, just a massive 1 year number there. Strong returns again, over 12% in fixed income, opportunistic fixed, 10%, multi-strata, non-core real estate really being the one that struggled there during the 1 year with the challenges in those markets. The private equity number obviously looks a little strange that we've talked in the past about. It's really dangerous looking at that whole private public equity over short time periods because of valuation lags. You see that kind of bear out on the longer term time frames where you see the private equity numbers north of public. And then the other real interesting thing I thought when I was looking through the data was, I'll focus on the 15 year, for example, is what was the return experience that we realized versus the asset classes, if you're building that out, doing the asset liability work and putting in return expectations relative to the risk of asset classes, are there any surprises or did you get what you kind of would expect relative to one another? And it really, to me, kind of looks like what it would when you were building it out. You saw the strongest numbers there on the equity markets, public equity at 10%, private equity north of that, which you would expect some kind of premium for the liquidity, everything in line there. Fixed income on the lower end there at 3.5. And then as we get a little more illiquid away from that, opportunistic fixed ahead of that, core real estate a little ahead of fixed income as a whole. So really, it kind of looks like you would expect it to do if you're building out that process. So I thought that was kind of interesting. Flipping to slide 28, the heat map here for asset classes. The only real takeaway here is if you look at 23 and 24, they look almost exactly the same, the year to date currently and last year. Same things going on in the market. Public equity strong up top. Opportunistic fixed, kind of anything kind of credit sensitive and risk on there, and your lower risk assets doing a little bit weaker on the bottom side. Moving to slide 29, looking at any new incremental and unfunded investment commitments here. On the left-hand side, you'll see a few new items in there, 3 from the private equity side and 1 as well on the inflation sensitive. And then on the right, looking at the unfunded commitments, when we sat down last time, that number was $6.7 billion. So we're down roughly $200 million from last quarter. You can see the numbers there by asset class. And then slide 30 will kind of take you on a trend line of that as we look historically where we've been there on unfunded. You can see that number down to 6.5 and the yellow bar that you see there. And what that represents is the percentage of assets. That number was at 5.5% of the assets when we sat down last quarter, and you see it 5.11 there currently as it stands. So continue to trend downward.
Let me add that for Treasurer-elect Briner's purposes, we have not stepped on the gas in the fourth quarter to put things out before you got here. So there are some co-investments we're doing, add-ons, 30, 50 million. So this was obviously you're inheriting a much lower unfunded liability. I mean, unfunded private asset class commitment ratio than I did. So anyway, that's
Sure.
That's what we've done. And would you also kind of add to that, if it belongs, that I believe distributions back from private assets are down some. So then that kind of G-Haul with this, I mean, the payments that we're getting back from private asset class.
Yeah, I mean, I think, well, our allocation is lower in general, so what we're getting back is lower.
Right.
But
It's been a slow year.
But this year as well has been slow. So I think it's a combination of those two things. We've had less, which I showed on that, one of the slides previously where we're kind of cash flow neutral now, where we were positive for several years.
Nothing really to comment on 31. Again, that one doesn't change very much. On slide 32, nothing new to report there on exit investment since our last meeting. And finally, we'll wrap up on slide 33, which reflects our top 20 investment managers.
You did that last chart after a state football game. When do you do that last chart? The other one. Which one? That one.
Oh, I try and take my mind off those games as much as I can, for sure.
Is that because you see tears on the page or?
I don't know.
There's no way that, yeah.
My alma mater's undefeated in football, so
Yes.
I can always say this.
Yeah.
We are definitely not that. So On slide 20 on the investment managers, obviously up top, internal fixed income at 30, almost 35% there, but, and the internal equity, I want to take a second on the internal equity, to stop and recognize that change since the treasurer, before he came into office. That didn't exist when the treasurer Falbo came in. We had stops and starts on that, done some work under the team, and he really helped gently push us and support us in that initiative. So, that being 25 billion that wasn't there, 8 years ago. Thank you for that support, and credit to the team for putting that in place and all the work there. But I think that's a big shift and a good thing.
It was a big goal, short deadline. When I got here in January of 17, I think there was maybe a 2-year deadline. And if my memory's right, Rhonda and Greg and Casey, I guess, at that time, screwed it up by October of that year. So,
And if we look at the rest of the chart, no real changes in the name. That last one always kind of flips back and forth depending on the markets. I think it was Marathon Asset Management last meeting, Franklin Templeton there. But other than that, the names on the chart remain the same from when we met last time. So that's kind of the last comment. We'll be glad to field any questions as it relates to the performance review.
as far as proxy voting, all these public equity proxies, we still use the customized.
Yeah, so Glass Lewis votes are proxies for us based on our essentially guideline approval, I guess.
Right.
So we can customize that to the extent we want to, have it as customized as we want, or we can use Glass Lewis's. They have different thematic programs and different, so we take a look at that fairly frequently. But yeah, we have the ability to customize that to the extent we want to. But yes, so Glass Lewis is the ones that votes pretty much all the votes.
They control the assets, but we control the votes.
Correct.
Jason, you want to add anything?
I think Chris Moore said it very well.
Okay. Next. Thank you. Let me just say, because last time you're coming up, right?
I'll be back in about an hour, but together, yes.
Thank both of you for stepping up to the plate as I'm cleaning out my office, and no giggles about that, by the way. Somebody was commenting on how good the desk looked, and somebody else said, well, it's been protected for 8 years. But anyway, I just, as I came in and we were facing a departure at the CIO position, I was just reading all these stories in P&I and CalPERS and CalSTRS and all these funds from across the country where the tenures of CIOs was very short. I think we had 8 and 12 years.
Right around there, yeah.
Something like that. And but then when you keep reading P&I, pensions and investments, you saw that generally anytime there was a transition, the folks that you would see out in the audience here would completely change. The investments that they had chosen would completely change, blowout of personnel, blowout of investments. So I chose stability and certainty. And but for the two of you stepping up and agreeing to do this in the way that you've done it, that would not have been possible. So I'm not closing my remarks, but I just want to thank both of you, your families, the staff that supported you for stepping up to the plate and taking on this position. And I think it's worked magnificently. So thank you.
Here, here.
You ladies dressed alike.
Well, we appreciate your support all the way there, and also wanted to thank the committee members. We've enjoyed the dialogue and the time spent with you, and appreciate your time that you volunteer to us as well.
Did I hear?
Mike just said here.
Oh, I'm sorry.
Here, here. I'm here.
Thank you. Thank you very much.
Thank you.
Next is our CEM benchmarking.
So this is Paul Washa Simon
There you go.
from CEM. The folks that have been on the board, on the committee for a while know of CEM. We do this every year. We've done this analysis, I think probably for the last decade or so, where we go through and it's a big process for us to, CEM does, they do the investment effectiveness analysis. They look at our portfolio, compare it to peers in terms of costs, and she's going to go through the whole analysis. But in doing so, we have to go through a large mapping process to map our assets to sort of the categories that CEM has. So, it's not a clean thing where our investment policy statement, the way that we've structured our portfolio maps cleanly to what CEM does, because they have to, normalize all the assets, all the different clients and to be able to compare them appropriately. So it's a big process that we go through every year. It takes a long time to go through and gather all the data, gather all the costs, gather all the fees, and work with CEM to make sure that all the data looks accurate. So it's a big process, but I think it's worth it. I think it really shows kind of where the portfolio sits, where we're high cost, where we're low cost, where we could improve. And I'm hopeful we'll continue to do this going forward. So anyways, I'll turn it over to Paul Washa to go through the portfolio. Or go through the
Thank you, Chris. Good morning, everybody. I'll just give you a little bit of background in CEM, and then we'll go into the results. My name is Paul Washa Simon. As Chris mentioned, I am the product manager for this service. It includes this report, but it also includes other data and insights that we produce for our global clients. I'm stepping in for Christopher Dahl, who probably you guys are familiar with. You've seen him last year. He'll hopefully be back next year unless he has a conflict again. He's in Ohio right now for another client that he had a prior commitment. So I'm stepping in for him, but hopefully he'll be back next year. I will go through your results shortly, but just quickly spending a minute or two giving you a background of CEM. I know most of you are familiar with us. We have been here before, but I know Treasurer-elect Mr. Briner is new in the room. And so just to give you a quick overview of who we are, if you go to the next slide, please.
There'll be a slight lag.
No problem. So I'll keep talking.
CEM has been our advisor since it's pre-Dale, but
it's been about probably at least 10 years. Yeah, we've been doing that. 2013, I think maybe was the first time.
So we are a data and insights company. I wouldn't call us advisors or consultants. We are an independent company. We provide you and equip you with a data insight so you can make better decisions for your members. That is our mission. We have been doing this for, to be precise, 32 years now. We have coverage in 20 plus countries and serve more than 500 plans. In this subscription, the investment benchmarking subscription, which is primarily defined benefit focused, we have about 300 plans participate on an annual basis. The majority is in the US, but that's not the only region, so I'll go over that shortly. Other subscriptions that we have are on the defined contribution side. We also do benchmark the other side of the house, the admin side, so service and costs on that side as well. We have transparency benchmarking, and then we also have peer-based communities where we bring together peers in various regions for specific research and discussions in a conference. So that's some of the stuff we do. Just wanted to give an overview of who we are. Again, not consultants and advisors, more like an independent party here to give you the data insight so you can assess your results and make the right decisions.
Just jump in real quick. And we do utilize them also for the defined contribution plan as well as the pension and administrative side of it as well. That one we typically do every other year. One year they'll do the DC plan, the next year they'll do the pension administration. The investment one we've typically done annually.
in the past, we had two different vendors, right?
No, we've had
On the
CEM
DC?
for this analysis. No, it's been CEM.
I'm mistaken.
Okay, so moving on, now we can go into your story for the year ending December 31st, 2023. So I won't spend too much time on the return side of things. I know Chris and team have already spoken about it at length. You do get more recent return analysis on that, from your staff. But the way to look at these results is this is more to assess, we're paying in certain asset classes, are we getting what we're paying for? It's also to assess, if we have chosen certain implementation approaches, are they a performance drag on our total fund performance, and to assess whether we are on the long term creating value for our members. So high level for the 5-year period ending December 31st, 2023, your 5-year net total return, which is net of all costs, was 6.7%. This is below the U.S. public median of 8.7% and the peer median of 9.2%. No surprises there. Chris already shared that with you. The 5-year policy return was also rounded to 1 decimal point, about the same, 6.7%. Again, below the U.S. public median of 7.5% and the peer median of 7.5%. Your policy return and ultimately your net total return are a function of your policy allocation and ultimately your asset allocation. So we'll go into that later, but just wanted to point that out. Your value added, which is the difference between your net total return and your policy return. So in other words, the alpha generated in excess of your benchmark was neutral. It was zero. Your policy return and net total return were about the same. This was again below the U.S. public median of 1.2% and the peer median of 1.5%. Your risk is also one of the lowest, actually, in fact, the lowest in the U.S. public space. We'll go into the details of that, but your risk was about 9.7%. This is us modeling your risk on a standard basis for you and for everybody else. This was, again, below the U.S. public median of 11.7%. On the cost side, your total fund costs, these are investment costs for external management, internal management, and top-of-the-house costs around oversight, custody, consulting, all in were 25.3 basis points. This was below the benchmark cost of 30.9. We'll talk about the benchmark cost in a moment. This does suggest that your plan is low cost compared to the peer group. Why are you low cost? It is primarily because you're paying less than peers. So it's primarily because of lower fees. We also note that your costs have decreased in the last 5 years, going from about 32 basis points in 2019 to about 25.3 today. When I say today, I mean as of end of 2023. So that's a decline of about 6.8 basis points. Where is that coming from? We'll again dig into that shortly, but primarily it is because you've moved into a lower cost asset mix. And also because you're paying lower fees today versus 5 years ago. So that's the high level story. We'll go into the details of all of these, but before we do that, I do mention U.S. public median, I do mention the peer median, so let's quickly talk about what these subsets of the CM database are. So when I say U.S. public median, that is about 43 that's 43 plans in the CM database that are U.S. public plans. This is generally, most of them are state plans. The average size in this group is $26.7 billion. They constitute altogether $3 trillion of participating assets, so they skew generally large. This is the peer group, the universe that we will compare your performance against. Just to give you a high-level overview, you can see when I said earlier we have a global database. We have participation from the U.S., we have Canadians, European plans, Asia-Pacific, and other regions, including Middle East and Africa. So that's the total database, and as of the time that we ran this report, we had about 283 plans in the database whose data was finalized. So this is the database, and of that, U.S. publics are the universe that we'll compare you against for performance. Moving on, the peer group is within this U.S. public universe. We have chosen, I believe, 14 plans. If you scroll to the next slide. 14 plans within this subset who are, we are calling your peers. These are plans that are similar to you in size. This is to account for any economies or diseconomies of scale that you would have by virtue of your size. Of course, given your size, you would have, we assume, economies of scale. And so we would we want to neutralize for that. So if you pick a peer group that is relevant to you in size, you are about the median. You're sit roughly in the middle of the group. So the median size of this peer group is 110 billion. That compares to yours, 113 billion. So this is the peer group against which we will compare primarily your costs. With that, let's go into the story for 2023. So again, just rehashing, 5-year return, 6.7%. If you look at the individual years on the right, the graph is showing you the returns for the individual years. Your net return has generally been in line with the broad universe, except for, I'd point out 2021, and that does, have an impact on your 5-year number. So, we're looking in the rear view mirror. At some point, this will become distant and you'll have more years here. So hopefully the return story will improve. But this is the story as of end of 2023. Now, net return by itself has two components in it. You've got your policy, of course. Your policy allocation will drive that, but also the alpha generated in excess of the policy return. So we decompose those components in the following slides. We talk about policy return on the next slide, which shows you that your policy return also stood at about 6.7%. This, again, is going to be a function of your policy mix, which is, as you know, would be driven by your capital market expectations, your duration of liabilities, your appetite for risk. So all of those things will impact your policy. And you've chosen a policy which, if you go one slide down, will show you is more fixed income heavy. You have more or higher allocation to fixed income, and I'll note, cash also stands out. You have a higher allocation to cash than does the average plan in the U.S. public universe, and so that does impact your policy. If you look at the two columns on the right, those are showing you the average benchmark return for these asset classes, and you can see fixed income does generate lower returns. And so that impacts your policy allocation. Again, in contrast, your allocation to public equity is about 5% lower compared to the average U.S. public plan. And also private equity and real estate, I note, your allocations are a bit lower. So that does impact your total policy return. If you go one slide down, your policy mix, of course, given that it's fixed income heavy, translates into a lower modeled risk for you. So we see that you are the lowest risk plan in the U.S. public space. This is the standard deviation or the volatility of your policy mix that we have modeled on a standard basis for you and everybody else. And so you stack really low. That's the green dot is you at the bottom of the distribution. Now, if you go one slide down, we looked at policy allocation. That's, again, policy return, which is a component of your net total return. But then the other component is your net value added, which is, the excess return you generate on top of your policy return. And we see that has been neutral over the last 5 years. Again, 2021 stands out as one year that had a significant impact on the 5-year number. 2019 also seems like your experience was different than everybody else. But otherwise, the other years you've generally been in line with the experience of the broad U.S. public universe. I think after this we go into, so that was total fund. Actually, we do have one more slide on performance. This is where we look at high level, the different programs or the different asset classes and your performance within each. High level, generally in line with what we see in the peer group in the universe, except for, I note, real estate and private equity performance has trailed when we compare with the universe and the peer group. But otherwise, generally has been in line with others' experience. So that's all on performance. If anybody has questions, otherwise I'll move into the cost side of things.
So it's about risk calculation. How do you measure private asset class risk for your purposes, particularly given the limited duration of those categories historically?
So for each one of the private assets, we use a public proxy. So for private real estate, for instance, we have a REIT proxy. For private equity, we have a public proxy. But again, we would lag it. In case of real estate, there would be some de-smoothing. And so that is all taken into account. So each one of those proxies, we assess the volatility of the proxy we've used over the long-term period. So that's how we get to the return. The risk. Okay, so switching gears, moving into the cost side of the picture. So total costs, excluding private asset performance fees, at the end of 2023 were about $287 million, which translates to about 25.3 basis points at the total fund level. We're showing you the breakdown of the costs by asset class here. I won't go into any details here, but just pointing out that, as you would expect, private assets and alternative asset classes, I'd note privates plus hedge funds, do generally cost more than public assets, and that is evident from this breakdown. So going on to the next slide. How have your costs trended? We talked about that in the opening slide. Your costs have trended consistently lower over the last 5 years. We see a decline of about 6.8 basis points from 2019. Now, this decline can be primarily because of three reasons. It could be because you have changed your asset mix. If you move into cheaper asset classes, that's going to have an impact on your costs. It could be because you have changed your implementation approach. So you may be doing more passive, you may be doing more internal, maybe doing more co-investments. All of those are cheaper relative to their alternatives. And so that will have an impact on your costs. And then finally, it could be because you're paying lower fees. So even if you haven't moved assets into passive management, internal management, but you may be negotiating fees with your manager, that would have an impact. So those three are the drivers, and we look at the three drivers. For you, the big story is asset mix. You have moved into a lower cost asset mix over the past 5 years, more fixed income, less of those alternatives. So moved out of hedge funds, moving out of private equity and some of the other private assets, real assets. So that has impacted the decline in your costs. On the implementation side, there has been a little bit of increase. You have added more active management, so that's added to your costs. But then again, on the contrary, you have negotiated fees or are paying lower fees today versus 5 years ago. So that's driving another 2.2 basis points in savings. So net, your savings or the decline in fees has been about 6.8 basis points. If you go to the next slide, that's you. We do look at the trend versus the peer group and the universe. And if you look at so black is you. If you look at the blues and the grays, those lines have been fairly flat. If you look at the chart on the left, that's showing you total investment costs, excluding only private asset performance fees. The right one is showing you total costs, excluding all performance fees. So public asset class performance fees are also excluded here. We see that peer average has actually gone up slightly. US average has actually gone a little bit down over the last 7 years. But for you, it's been a substantial decrease. It's quite noticeable. And that's true, when you exclude private asset performance fees and also public asset performance fees. So base fee side, it's been a huge decline. We don't look at performance fees here because performance fees, as you can imagine, are volatile. They will be driven by performance. So excluding that, if you look at the base fees, that's been a drastic decline. If you move on to the next slide, we stack you up for the 2023 fees versus the peer group and the US public universe. And interesting to note here is where your green dot is placed. It's right at the bottom of it's off the distribution. You're literally the lowest cost plan in the peer group and one of the lowest in the US public universe. It is primarily driven by the fact that you have more fixed income. Fixed income obviously is much cheaper. If you read the text, you'll see you have about 22% in alternative asset classes, which includes private assets and hedge funds, whereas peers have more than a third of their program, about 38% in alternative asset classes. So that is heavily driving your cost down. But that does mean that looking at this comparison is flawed because it's asset mix driven. So just by virtue of putting more money in cheaper asset classes, you will have lower costs. And so one of the things that we do is adjust for these differences. And that's the next slide where we look at your costs on asset mix adjusted basis. What this is saying basically is that if we gave your asset mix to your peers and had them implemented on their median costs, what would a plan like yours, given your size and your asset mix, cost? So we expect a plan like yours to cost about 30.9 basis points, given your asset mix and size. You are at, in fact, 25.3 basis points, so you're saving 5.6 basis points, which translates to about 63 million in fees. Where's that coming from? We look at that on the following slide. Now, just to quickly rehash, because we've already adjusted for size by virtue of the fact that your peer group is similar to you in size, and we have adjusted for asset mix differences. So now imagine you have the same asset mix as the peers. If you're still different from the peer group, why would that be? That could be two reasons. One, you may have a different implementation approach than peers. You may be choosing to do more passive in certain public asset classes than peers. You may be doing more or less of fund of funds where you have to pay 2 layers of fees versus direct funds. You may be doing more co-investments. So all of those implementation approaches will drive your fees. The other reason you could be low cost is purely the fees you're paying your managers. And so those two are shown here, those two factors. On the implementation side, you are a bit high cost, 3.9 basis points, and that is because you have more fund of funds, high level. You do have less of co-investments. You also have less of those open-ended type structures. So you're using direct funds, LP structures, than core open-ended structures. So those add to your cost. But on the flip side, huge savings on the fees. You're paying less to your external managers. You're also paying less on the internal investments. And top of the house costs are also lower. So on the fees side, significant savings, which translate net to about 5.3 basis points. We dig into each one of these factors in more detail on the next two slides. I won't spend too much time on this, but I will give you a high-level view on the implementation side. You can see the right graph is showing you, if you look at for instance, the grays, the two shades of gray, that's your internal management. Compared to the peer group, you have more of that. If you see the thin sliver red and the orange is the co-investment, red is fund of funds. You have more of fund of funds than the peers, less of the co-investments. So all of those translate into higher cost, relative cost against the peer group. If you go to the next slide, that one is speaking about your fees. We have broken down as a huge wall of numbers. I won't go into the detail of this, but it's showing you the fee savings or excess fees where you're paying by each one of your asset classes or programs. The column worth looking at is the extreme right column. The extreme right two columns, in fact. That's where you can see the net savings on fees and hedge funds, performance fees in particular stand out. Your private credit program stands out. Your natural resources program stands out. So all of those. And then on the right table where we're showing internal management, your U.S. fixed income, which is internally managed, that really stands out. So all of those are programs or asset classes where we see significant savings on fees. If you move one slide down, this table is simply summarizing what we just discussed on the implementation side and fees side for each one of your programs. Again, won't go into the detail, but it's the same story coming through. Hedge funds, natural resources, private credit, U.S. fixed income, some of the asset classes where we're seeing significant savings in both style and fees side. One level down if you go, one more slide. So this slide, I think we have shared this with you before as well. This has become part of our standard reporting now because it's interesting. A lot of the times people focus, take a myopic view and focus a lot on, internal fees and what are we paying our internal team. And, but forget that compared to external, it can still be quite cheaper to do certain asset classes in-house. And so this table really illustrates if you were doing some of your internal management externally or it was outsourced, what would it be costing you extra today? It's about 39 million in fees that you would have been paying had you been doing this externally. So kudos to your team for bringing it in-house and running it in-house. Again,
I ask you to put this slide in here.
I think this is one slide we've chosen to put in everybody's report that has internal management. I think it's an interesting slide to look at. Yeah. But yeah.
I'm just blushing, but I'm just.
Right. That's a fair question. But yeah, again, fixed income US really stands out here, 36 million in savings. I think we have it after this. We have one more slide, perhaps, or maybe two. Yeah, this is, I think, the final slide. So this is where we summarize your cost and performance story. So x-axis, your excess cost. This is your position relative to the benchmark. Y-axis is your net value added, so alpha generated in excess of the policy benchmark. And it places your triangle, the green triangle is you, on the left and on the x-axis, which is a good place to be. That's relative to low benchmark, your low cost. And on the y-axis, it's placing you on the zero line for now, but everybody strives to be in that top left quadrant, which is low cost, positive net value added. And I have no doubts that hopefully by next year you'll be there. I think that it's 2019 number drops off, and at some point 21 drops off. In that triangle, it'll keep getting pushed up. So I think it's a good story. That's it. I think we have one more slide that just says thank you with my picture and Chris's. So you can see who Chris is, if you've forgotten. That's an old picture of me, but thank you for giving me the opportunity. And that would be it. Any questions?
Could you go back briefly to slide 18? I'm having a hard time understanding what we're stating with the 3.9 basis points.
This is saying that agnostic of what you're paying your managers, agnostic of fees, how are you implementing your certain asset classes compared to peers? And are you choosing more cost-efficient implementation approaches? Now, not everybody can do everything internal. Not everybody has access to excellent co-investment opportunities. Maybe you have some legacy, and I think that is quite true. Chris, you can correct me if I'm wrong, but you may have legacy fund of funds that are, over time dying, and at some point will drop off. But some of those implementation approaches, which maybe historical, maybe it's the investment environment that drives it, will have impact on your costs. So the 3.9 basis points is the sum of the different implementation approaches in your public markets and your private markets.
So thank you. So for example, the third entry, more internal as a percentage of active, 1.2 basis points. Is CEM of the conclusion then that we're paying more because we brought that internally?
So this is saying, and again, this is an interesting one. So this is comparing the impact of your internal investments versus peers. And so if peers' fees are lower, it does come through in this number. Generally, internal management would be saving you money. In this case, it's showing that it's about 1.2 basis points in excess, but it's a wash when you look at the total.
This one we looked at close because it's not intuitive. You would think that would be a negative, but so for us, it's most of our internal active, almost all of it, except for that small sleeve in equities, is core fixed income. So some of our peers, a lot of our peers manage equities actively, which is more expensive.
Right.
So we're managing a less expensive active portfolio because fixed income is naturally less expensive to outsource than equities, right? So if you're paying, I think it was 13 basis points was the average on a fixed income active, whereas equities you'd be 40, 50 basis points or more sometimes. So if our peers are managing equities internally and we're managing fixed income internally from an active perspective, it's higher cost than our peers from that perspective. Does that make sense? Yeah, we did look at that because I thought the same thing. I'm like, that doesn't make any sense initially when you first look at it. It's not really intuitive, but
Functionally, they're saving more than we are because they're bringing in a higher
cost. Yeah, exactly.
Wow.
Does that make sense?
So the higher expense asset class we bring in, the better we look.
Yeah. I mean, essentially, if we're managing something internally that's higher cost, if we outsource it,
Right.
then we're saving more money, right?
Okay, got
We
it.
save a lot of money, as we just showed managing the fixed income. We save $36 million a year by managing the fixed income internally. But if we were to manage the same amount in equities internally, that cost would be, that savings would be much higher, right? Because the active equities are generally higher cost than active fixed income.
All right, thank you for that.
John?
I have a question. I was a little surprised to hear that we're still higher in the fund of funds area. We've been trying to unwind that for.
Well, I mean, it's legacy fund of funds that are just winding down. I mean, it's taken, most of those are vintage year, by 2010 and before, to be honest, but we still have, I think it's like 0.3% of the portfolio, but it's still a slug that's still winding down. So we definitely still have that, and it's still, and again, if you look at this year to year, it's been getting lower. It's been decreasing because certainly that hasn't been a priority to do any new fund of funds. But for the most part, those are really legacy fund of funds that just take a long time to wind down.
And then if I heard correctly, we're a little behind our peers in co-investments, and intuitively, I think we've been accelerating that.
Yeah, we've been doing more, but our peers have been doing more as well. So I think it's probably just the sizing issue of how much, obviously how much they're doing versus us. So, co-investments in general are, I guess, more popular with a lot of our, especially the larger peers, our actual peers, right?
Yeah.
I think that's been a focus for a lot of our peers. So it's probably just that, they've been doing more, even though that's been a focus for us.
And we'll probably for longer too.
Yeah, I'm sure.
It's also a factor of concentration and, the size of your commitment with the manager. So if you have less concentrated portfolio, that would also drive how much you have or how much access you have to co-investments.
Other questions? We refer to the legacy as Hotel California. Check out, but you can never leave. So one of the writers of those songs died yesterday, actually. My question is, if my memory's good, typically we get a slide that looks like slide 4 that shows us as the most efficient 2 out of the last 3 years plan in our peer group.
The cost line? Is that what you're referring
Yeah,
to?
it looks sort of like this, but it's more spread out. So is slide 5 that slide now? So we're not.
That's just showing
This one is just showing you how you compare in terms of size with the peer group. I can't seem to recall what that slide would be.
In terms of the cost, slide 15 is the one that we usually put in a lot of the slides that show that we are the lowest cost on the peer group.
Well, we were, and then we weren't last year, and then we are again. That's what I'm trying to get at.
I think we've been the lowest cost for the last several years versus our peers.
Okay.
The second last slide is what shows you your relative position against the benchmark for each of the last 5 years. This one, as Chris mentioned, is showing the absolute cost trend.
In the past, because I just threw away a bunch of this stuff, there was a thick book, and one of the slides looked like slide 4. Forget about what slide 4 says, but it had the peer group and then had North Carolina way over here on that's the lowest.
Yeah.
So, anyway. Okay, any other questions? So we are the lowest?
You are the lowest. If you go one slide up.
We weren't last year.
Chart there.
I think we were last year, and we were the 0 percentile for the
I
last,
think, yes,
3
you
years.
were, I believe. Like, if I were to make a bar graph, putting like each bar representing the peer group, you would literally be the first bar
That's what
on the left. Yeah.
The last 3 years, but last year we were second one over 5. My memory's good.
Maybe that's in the broad U.S. public universe. In the peer group, I think you have been the lowest.
Yeah, if you look at the broad U.S. public we're at the 5th percentile, so we are probably like second.
Okay. Well, thank you. And knowing what I know about the Ohio plan, I'm sure that Christopher is much needed in Ohio. So, but we're glad to have you.
Thank you. Appreciate it. Nice to be here.
Come back.
Pleasure.
Now you have an opportunity to meet Treasurer-elect Briner, so this is all good. Any other questions?
Any other questions? No?
If you have to fly out somewhere, feel free to leave.
Thank you. Nice meeting you all.
Would that be accurate?
Yes.
Welcome. Happy Thanksgiving.
Thank you. Appreciate it.
I want to.
Okay. Before we get started, talking about fixed, I know that traditionally when the fixed income meets here, you see Brett and I here. There's 3 other members of our team currently. Market doesn't stop for the board meetings. We still have new issues and repo and those kind of things to deal with. But I did ask, one to step down here, Brad Bullock, if you just stand up so you know you are there. So the reason I wanted to just take a moment to thank Brad is he'll be retiring in the first quarter. I didn't want to miss the opportunity to recognize Brad for what he's done for the department and investments in fixed income. He's been with the department for 22 years, and 15 years of those in IMD. Previously, he was in FOD for a while on the accounting side, and 10 years in fixed income. And Brad's role, primarily, he's the one that's dealing with our daily cash flows, our repos, executing repos, working with our counterparties to get all the collateral to custodian, handling our corporate actions in fixed income, as well as working on our core fixed income portfolio with new issues and secondary trading and things too on it. So obviously with all those things, he's going to be missed. And in addition, Brad to me is really representation of the culture that we try and promote over time within the investment team on it. High character guy. He has appreciation of the mission that we have and the people that we serve. Reliable. He's going to be here. One thing unique about some of our roles, especially on the desk where we have to do cash flow, is there's some state holidays where banks were open. The day after Thanksgiving, obviously the mine coming up. Somebody's got to do that work still. So, I can always count on Brad. He was a fast learner when he came on fixed income, and he's really respected in all of IMD, wherever he worked, and even in FOD. So I just wanted to take a minute to thank you for your contributions to the team and also to the state and everyone else. So thank you a lot.
And after those kind words, I'm going to have to go.
He's got to go get a repo done. So
Get back to work.
the work doesn't stop. So thanks, Brad. Appreciate that. Truly a good guy. And he actually gives, having gone through the 10 years with a teenager in his years, he gives great parental advice too.
Yeah, I've definitely enjoyed working with Brad. He's a good guy, a stand-up guy, like you said. I also enjoyed his sense of humor, and he seems to get my sense of humor, which is kind of unusual sometimes. So,
An acquired taste.
maybe so. Yes.
That's what the time will do together, right? So
That's right.
as a matter of backdrop, so I mentioned Brad had been with the fixed income group specifically for 10 years. And we really get each other's humor because we work together so long. Brad's the least tenured group in my group. Brad's been with me and the team here for over 25 years.
It's my 26th year.
And then the other 2 members we have on our credit research side are both over 20 years. So I joke around sometimes in interviews with people. It's like, when you're looking for another job, you better focus on that you enjoy the people that you work with, because Monday to Friday, you're with them more than you are your family. And I've been blessed to have some great people here that I've been able to work with over time. And one of the reasons why I've been here since 91 today. So with that, we'll hop in. I'll let Brett talk a little bit about the short-term portfolio.
Sure. So the slide you see here, we showed every time in the IC. It's basically the slide that we provide to our STIP participants quarterly. Just as a reminder, you'll recall that by policy, the STIP maturity range is 0 to 5 years. Current average maturity is 1.7 years, and it is managed on a cash return basis. So the top left, you'll see the bar chart there that shows historical annualized net cash return. Current STIP rate is 484. The short-term rate has rose over the last 12 months. Over this period, we've been reinvesting into higher yields for most of this period. As the talk of rate cuts increased, we began locking in some longer dated callables and longer dated lockouts as well. This combined with the declining short yields in the third quarter, we saw a less dramatic increase in the short-term rate as compared to last year. So moving to the right, you'll see moving to the right side of the slide here, you'll notice the STIF allocation. I'd like to draw your attention to the asset allocation. Basically, all assets are allocated across highly liquid securities here. The repurchase agreements, which Jeff mentioned just a second ago, that's also referred to as repo. And that's our portfolio's overnight cash vehicle. We basically manage that to meet the immediate needs on the portfolio. As of quarter end, that stood at about $2 billion. It's worth noting, too, that it's managed very conservatively. It's collateralized with treasuries and agencies and is delivery versus pay. It is a bilateral repo. So the treasury portion of the chart here, the pie here, is basically a fixed income, a front end ladder with a fixed income. And it's basically managed to provide an additional layer of liquidity over the overnight. Currently, we're laddering out about 1.75 to 2 billion monthly there. So we have about 20 billion maturing over the course of the next 12 months, and about 2.5 billion in T-bills as well. And the T-bills are laddered more on the front end of the ladder there. So the agency portion of the portfolio, that's predominantly callables, where we have excess cash. We're able to basically invest that out the curve and basically pick up a little bit of yield there. So currently, that's about 23 billion of the portfolio.
Is it correct during contagions or dislocations that, unlike a lot of other states, when something would fall below an investment grade in this portfolio, we're not required to sell?
Never in this portfolio have we had anything.
But we can't buy.
Well, what that really is referencing more is our core fixed income piece.
Yeah.
Whereas this one is really restricted on really not really taking risk here. There were some issues going back to the crisis period where there were some structured products that people were doing that caused some even state plans to break the buck on that. And we never had any of that. This is pretty plain vanilla. It's not the place for risk. And we fought ever pushing it on that front.
Historically, very limited credit exposure in this portfolio at all.
So technically, you can do AAAs. There's hadn't really been any left for
AAAs,
quite a while that you could do in a meaningful amount if you wanted to, even on a book this big.
Yep.
Thank you.
So at the bottom, you'll see some additional portfolio characteristics for your review. If no other questions. Next slide. So in this slide, you'll see the historical STIF rate history. Just as a note, current assets under management in terms of par are about 48 billion. So the STIF rate is in red, and iMoneyNet composite benchmarks is in yellow. Also included for reference are comparable treasuries. Notice to the right that all rates have begun to either intersect or converge closer to STIF. Just again, as a reminder, the STIF will outperform comparable rates due to our ability to invest out the curve and pick up yield, as well as the normally positive shape of the yield curve. And we will underperform when rates are rapidly rising. So if you'll recall, it's been kind of a challenging environment. So as you recall, the curve has been inverted now since 22, and we've had a period of rapidly rising rates. So we've also had some of our lower securities starting to roll off and be able to reinvest out and pick up a little bit of yield. So the STIF basically is finally catching up there. So as of quarter end, as I mentioned, the STIF rate was 484, iMoneyNet was 506, the 6-month bill was 440, and the 1-year constant maturity was 403.
I think one of the challenges we've had here is, we looked up, it was 2 years. We've had an inversion on the front end for over 2 years, which is, we went back quite a while. We couldn't find it that long for a while. So
over the last 20 years,
it's really restricted the ability for us to go out the curve and pick up that yield. And that's kind of one of the trade-offs, even when I know we did a presentation to the legislature last year at some point with a question about the rates. And the trade-off on our model here is, the way we do it is we can go out farther. To some degree, it's a little bit of a captive because it's not just pension assets that are in here. There's hundreds of participants. And by that normally shade yield curve being positive, we can add that over what you could do if you were doing a true money market. So you can see in most time periods, you get a benefit of that structure. there's a trade-off when you get the other on it. But long term, it's a better deal for them. It's just been the increase was so quick that there's such a lag getting on that, and finally seeing most of those old securities kind of go off the book now too. So, I'll pick it up a little bit here on slide 4. So taking a look at the profile of the investment grade fixed income as a whole, on the pie chart on the left, you'll see the core fixed income being the blue part, and a lot of the time we'll spend really focused on that, so that's the majority. The red is just a participation in STIF, and the green there left is a short IG credit. That number was 6% a year ago, it's 4.3% now. And that was really the residual we talked about. We did some of that as a proxy for, we had really short credit spike up. We did some stuff there in that space, and we bought stuff in core and let it mature in and put it in that bucket as kind of a proxy to add value over where STIF was, given we had raised near zero at the end on it. So that part worked out well. But, historically, we've been at that 90-10 split that we had talked about for years here. And really that 10% was always the theory that we felt like changes that were made back in the crisis and Dodd-Frank was going to cause liquidity problems at some point when everybody wanted out. And as you remember, we utilized that authority and utilized that cash. And it was a great time during the COVID crisis with spreads until the Fed came in and ruined the party for us, backstopping it. But that's really, I think that basically there's some point again where that's going to happen again. And hopefully you have the ability to take advantage of that. As far as where we are, relative weightings in core fix, when we look at there, we're slightly overweight corporates, a little underweight treasuries on the flip side, running cash at a pretty low level. The return numbers on the left, on total IG fixed, you see that big number we touched on earlier, Chris and I did on the double-digit number there too. The numbers underneath where that benchmark is for the side, and that really reflects the fact that we were hesitant to go out and invest fully in the long end of the curve, given concerns over inflation, and nothing kills the long end worse than inflation. And so we just didn't feel like we were getting compensated for that risk. So we're a little under there. You'll see that start to unwind when you get the longer periods. And we'll talk a little bit about that on what's happened since quarter end. But investment grade fixed income continues to outperform over most time periods, as you see in the rest of the chart. So what drove that slide again is the rate decline. 5-year was down 100, 10-year was down 80, 30-year was down roughly 60. And when we look back at that, always in the end of my slide, I have that bond yield forecast slide that comes out of Bloomberg. And when I went back and looked at the one from a year ago, it had been way off for a few years. Year to year, it was really pretty consensus. It was around 100 or so to 80 last year on that. So that would actually turn out to be pretty accurate on what we experienced for the year. So, moving on to slide 5. Just looking at the allocation a little more within our core fixed income portfolio. There you see the breakdown of treasuries, agencies, corporates, and Ginnies. We did have a little bit of a nuanced thing. So in the mortgage piece, remember we're doing Ginnie Mae 30-year pass-throughs, eliminating really the credit risk, full faith and guarantee on it. And things we want to do aside from that mortgage-wise are really done structurally in Ron's book, and he'll talk about later on. There was a change there. There had been a talk about changing how that settlement was going to work. We were a little concerned about it. They'd been kicked down the can on the road for a few years, and we were going to have to set up and essentially post margin while we waited for that, because we might do a treasury and it might set up for 3 weeks. It's going to be an issue. Well, it ended up being a non-event because at least most of the people we talk to, brokers-wise and other counterparties, are just settling it with a reg settle later, and everybody's kind of moved to settle it then. So
basically things moved to an early origination, and it's a win-win for the banks. They're able to get it off their books, so they eliminate a liability, and we're able to do T+1 earlier in the month. So
Legal was happy because we were going to have a lot of agreements to work through.
Legal's happy?
Yeah, because we didn't have to do it.
Gavel us out.
So on the right side, we got the corporate allocation by quality. You can see kind of where we sit here. Slight bit of high yield there is really reflects back on the treasurer's comment earlier, is we don't have forced selling rules, thankfully, on that. So if it's things that we still feel positive about, and we can leave them in the book there if we want to. Yields are down from where we saw a year ago when we talked about specifically fixed income. Duration similar. We narrow the duration gap, but are still short duration. And that's what drove that number that we saw on the return side of things on. Flipping over to slide 6. What you got drafted out here on the top is the 10-year and the bottom slide is the 30-year yield history. And if we look in the middle of the chart and we see that line moving down, it's hard to read. I know there's months on the end, but from April on down through September, that movement is really what drove that strong year returns. We had a material change as we went down the most of the year on it. And What I did update in here, because I think it's important, I know we're talking about third quarter, but on what happened since that period. So if I draw a red line down at the end of September on both these charts, and you see we've had a fairly material move since then, I think that's really a reflection of concerns over potential inflation with the tariff talk. Even October, we didn't know which way the election was going to go. Now that we know, we've kind of seen that number kind of stay up there. So I think that's going to be a lot of focus, especially as we get to the longer end on what that might mean for inflation as a whole. But it is a material change. And if you looked at the numbers, the performance numbers since then, that big double-digit number has retraced some, and also our relative basis and where we are relative to the benchmark is altered too as that number's come back in. So definitely something worth noting, even though it's really the current quarter. On slide 7, just have the depiction here of the yield curve and what the changes are. The gold part is where we were a year ago in September of 2023 versus the current in green. We referenced kind of that inverted curve on the short end. On the stiff side, you can see it visually here, what we talked about. And then if we looked at this number and I updated it, like I mentioned on the last slide, the green line would have shifted higher for what we've seen post the end of the third quarter. Moving on to slide 8, this really captures the performance of our core fixed income. The absolute numbers up top, the bottom has our performance over our benchmark, which we're obviously very proud of that. But what I really want to talk about is up top is the absolute number on it. And really, this is nothing new story-wise, but I keep trying to repeat, I know we talk about it. If you look at the experience that we saw from the 98 to 2020, and we saw really strong returns in bonds, it's a reflection that over that time, we really had the best time where you could have a fixed income. We started that period over 6% in the 10-year, and it really trended down over 10 years. And what you saw was great absolute returns for fixed. We saw obviously a great reset on that in 2022. We talked a ton about that, reflecting where it is. But, it's the things in the past aren't necessarily representation of going in the future on it. And I think that's really the heyday that we saw for that time period. So we're reflecting on what that is versus where we are now. I'll let Brett make a couple of comments here on the history markets.
Next slide. So on this chart, you'll see spread history for the credit markets. In green, you'll see high yield, red, IG, and then we also put the U.S. agency, which is very, very tight down the bottom. So moving over to the right side of the graph here, you'll notice that basically over the last year, corporate spreads have really rallied a lot. So over the last 12 months, high yield has rallied about 140 basis points, and investment grade has also rallied about 40 basis points. In investment, I won't speak too much about high yield. I'll let Ron and his team touch on that some. So just diving into the investment grade, basically notable sectors leading spreads tighter there are leisure, banks, real estate, and basics. And I will also note that as of 10/31, we saw a little bit of additional tightening there and investment grade about six basis points or so.
Which I think, getting back to we've seen that hold up as well too. Like stuff, if you think corporate tax rates should be favorable for corporates, we feel like the valuation here on a relative basis, you're like, wow, it looks really tight. But we're pretty neutral on credit. Don't really have any concerns over where companies are in general, and policies seem to be kind of favorable for them, minus any tariff impact for some. But in general, they don't see a screaming value, but aren't really concerned about credit either.
So on the next slide, we do monitor relative value in corporates. So at the graph on the very top there shows a good illustration of kind of where the sectors lie relative to their ratings and spread. So I will say over the last 12 months, you've seen the entire curve there shift lower. There's a lot less dispersion among sectors as well. Some notable changes there. You've seen banks and insurance and financial services move kind of closer to that line as well. So, moving on to the chart at the bottom, we also monitor sector weight relative to the index. The long-term portfolio is in blue, index is in red. Our relative exposure by industry is is fairly neutral. There's no overweight or underweight greater than 1% at this time. Honestly, there's really no notable changes from the last time we looked at that.
So in addition to the industry groups, we're also monitoring exposures at the corporate or ticker level. And we're getting that expressed from our credit research group when they have opinions on values in different companies within the industry group. So these kind of the layers we're putting on when we do the corporate work. Fixed income side. Moving on to slide 11, a lot going on here. This really is the table from the FOMC release they do quarterly of projections. And I'm just going to walk you through a couple of highlights. I'll try and kind of point to them a little bit. We'll start with the core PCE inflation, which is about 2/3 of the way down the chart there a little bit. And really kind of looking at it versus what we saw in the last June meeting. So what we saw was that there was down slightly really on the inflation expectations. We look at 24, 25, and 26, especially 24, 25, kind of down 10th. Last September, that number was 2.6, I believe, on the 2024 number. So we've seen that kind of trend down a little lower. And then if we looked at the right where they kind of quote ranges on that, we've seen that number decline there as well. So that number, if we looked at it a year ago, was 3.6 was the high end on 2024 and 3% on the other. So I think what it really shows is those long-term notes trending down show greater conviction, I think, that the inflation is moving towards target as we've seen them kind of move their own numbers down a little bit. On the Fed funds rate, we've seen that number again move lower as they've taken action. We were at 5% back in June when they released it, now in the 4s range for 2024. And then if we looked at the tendencies around that, we also saw that the rate cuts really kind of have come earlier than what they were predicting when we looked at their data from a year ago from the release. I think the interesting thing that we'll see, you're looking for in the December meeting, is we're going to see from the expectations and the ranges, I think is where we'll see the first expression of if there's concerns over inflation from the tariff talk. So that to me will be, when that table comes out, will be really interesting. We'll see what that brings. Moving on to the dot plot, again, different expression of the Fed's actions. If we looked at 2024, and we have the projection year ends, and the far right one's not labeled. That's because that's their long term. It's not a yearly. But if we looked at that number on 2024 and where the dispersion was of the different members' projections, I think it was roughly 2/3 of them were over 5% when they did it before on it. So we've seen that trend down with the numbers that you saw on the table. And then longer term, the notable part was on the far right is that the longer term median average was 2.5. And they actually, the members are showing a slight tick up from the long term average of where they see the Fed funds target rate in there too. So just a note point. On slide 13, this is the bond yield forecast chart that's a function out of Bloomberg, where they take basically a summary of all these predictions that everybody has on it and put them together in a table. I referenced it earlier in the chart, and that it was really fairly accurate last year. If we look at this chart now and say, what are the base expectations for it, 10 and 30 year basically showing a base expectation of around 50 basis points over the next year. With the shorter rates kind of down 100, that's really a reflection of what we have of potential cuts on the front end on that. And the Fed funds data that's on there for projections are pretty much consistent with what we saw in the dot plot on the other charts. The bottom has the 5-year TIPS break-even rate, just kind of a baseline thought about what inflation expectations are. Again, the similar pattern we saw in that move up in yields, if we looked at that chart in the last ramp up, it's been pretty consistent there now back for a couple of years, which to me just shows conviction that the Fed wasn't going to stop until they got everything under control. But we did see a little bit of a pop here kind of post the end of the quarter and coming out of the election, again, back to the possible concerns on any inflation from policies. On slide 14, this is always one of my favorite slides, and it's maybe not in two of, I'll walk us through a little bit. So what we're working here, I used actually the B of AML Domestic Master Index, which is a longer term data than our actual index, which only goes back a certain amount of period on it. And what we're really looking at is how good of a predictor is where yields are versus what your returns are going to have. We all know that if you yield to maturity at a purchase is what you'll own. If you hold it to maturity, that's what's going to return. But what about the interim in there? So the blue line is the yield to maturity on the date that's on the bottom of the table. And the orange line is the return over the next 10 years from that date. So if we looked at, the spike in 1994, you can see where the yield there is at that time, and that The orange dot there is the return from 94 forward to 2004. And really what it shows is that when you go through the asset liability work and doing all the return work on it, this is the easy one. You know, your basis is basically whatever your yields are at now is what you can generally expect. And it holds pretty tight historically on that. So as a reference point, this only goes to 2013. The 10-year number, I looked at it through the end of October was 1.9. So again, it's gonna be right in that range of that number. And then down below, so what does that mean for where we are? So this is using the proxy of our index, H167 on it. And you can see we had talked about for a long time, it was really unattractive period as we go back the last 10 or so years because of where yields were. You kind of knew what we were going to get over that time period. And now we're at a more attractive level, certainly. We've come back from that 6% range we were touching in 2023, but we're back in that 5% range for expected returns. Certainly way better than we were when we were sub 1% on the 10-year as a whole. So not nearly as bad a place as we used to be on it, and we have a general idea of kind of where we will turn, which I think the biggest challenge, and we had to get to that pain point of the reset, but we had talked back then, is the worst thing that could happen is you never had a reset and your expected returns for your low risk asset stay in that really low single digit number on it. So just a kind of a perspective from two different areas here. On slide 15, return expectations. Always love to show this to the committee just to give a baseline of kind of what we might expect here. As a reminder, this is just a basic age simulation. There's no credit movement assumed in here. It's just what happens if Treasury yields shift. The big thing we've seen versus a few years ago when we would sit down and talk about this, is when rates were near zero, that orange line component of income was basically non-existent. So now you at least have some buffer there to absorb some price returns on it. And if we talked about what was in that forecast or that 50 basis point range, maybe down, it really kind of leaves you in that mid-single digits kind of range expectation near term, what we could see. And again, this is just on a 1 year number here. The second bullet point, when I put this deck together, TIPS market showing limited concerns over inflation. I'd probably put an asterisk on it now because we've seen a little bit of a shift on that I showed you in the other chart with break even. I don't think it's necessarily at a material concern place yet, but I probably wouldn't say it's not terribly limited on it. So that's just to look at where we are on fixed income and positioning wise. I think as a whole, I would characterize it as a kind of fairly valued. I'm not crazy about credit, but we're okay with it. Nothing out there screaming for us as a whole, but not overly concerned. Probably the biggest, we've gotten through the election part of it. The biggest thing is focusing on what happens with some of these policies and what gets enacted and what doesn't. Kind of be the near-term focus for us.
Any questions?
Yeah, I'd be glad to.
Just curious, what's the duration of your index?
Duration of the index is running around 8.5.
So you're a half a year short of
About
that.
half, yeah. We were a full 1, and we narrowed all that down kind of over the last few years, but just didn't. Like I said, the bucket that's really underrepresented is that long bond.
Yep.
We just hadn't been up on that.
Thank you.
Any other questions? Thank you both very much. Now our last presentation. Presenters.
Just 1 second. Good morning. If Ming ends up doing all of the talking today, it's because my voice is under a little pressure. Seems like some allergies tried to get at me this week. So please be patient with us as we go through our slide deck and things of that nature.
I can have Anna bring some vinegar shots down here.
I may take you up afterwards.
All right.
But also, given that today is an important inflection point, I want to say, Treasurer, I really thank you for the opportunities you allowed me to have over the past 8 years. And also to Treasurer-elect, look forward to working with you in the future. And also to the board advisory members that are moving forward, really appreciate your service and all the conversations that we've had over the years. And that is genuinely a heartfelt statement. And I still remember the time, 2 times, Treasurer, that you allowed us to sing happy birthday to my 84-year-old mother in February. And those will be some definitely very memorable moments that I really appreciate here. And so, no further ado, I want to introduce myself to Treasurer-elect Ronald Funderburk, one of the investment directors here. I'm joined here with one of the portfolio managers on our team, Ming Xu, who'll get an opportunity to showcase a little bit about what we've been able to achieve here in the past year. Give you a quick outline for those, just because it's new for some, and we typically breeze through these because a lot of these slides are repetitive over the years, but we may take a little bit more time with them today, given that we have some new faces in the audience. But the outline for the presentation today is I'll give you a little background about the portfolio. Ming will talk about the performance of the portfolio and a little bit about the current structure of the portfolio. I will then talk a little bit about the current market environment. Ming will go into some of the more macro items associated with our opportunistic fixed income portfolio. And then I'll wrap up with what some of the implications might imply for the next year or moving forward as it pertains to the portfolio. So the first slide here is an oldie but goodie. It just reminds us what the role of the opportunistic fixed income portfolio is to the broader pension fund. There are 5 key goals for the portfolio: attractive returns, competitive relative returns, providing diversification, and first and foremost, really capital preservation. Never want to lose money. And depends on when you measure. We've actually done a really good job over the long term, but if you measure it on the wrong day, certain things look a little worse than others. But over the long run, we pretty much have delivered on all these key goals for the portfolio. Next slide. This slide showcases how we break the components down. We think about things in 4 areas: traditional, corporate credit, distressed credit, which is not a lot right now, hedge fixed income, open-end strategies where managers have the ability to hedge their exposure, and then special situations, things that are taking advantage of the current market opportunity or something unique in the marketplace. You'll get a chance to see and hear a little bit about the performance of each one when Ming speaks. But on the right shows how we think about what are the pieces of the pie that go into make the things on the left-hand side. And there are more pieces of the pie, but in terms of just making the chart very simple for consumption, this is what we decided to use. Next slide. This shows our allocation as of 9/30. Most of our slides are actually as of 9/30, but given that there's a significant amount of time to prepare these slides in advance, a significant amount of things have changed in the marketplace from 9/30 to today, and hopefully we'll get a chance to highlight that. But as of 9/30, we're 91 basis points below our target. And then, as Jeff mentioned in his slide, we had an asterisk on the reasonable risk reward to go beyond the target. And as you hear, spreads have compressed meaningfully since 9/30, but we'll still put an asterisk there because there still is a reasonable risk reward to go beyond the target on a select basis. Move forward. This chart shows the portfolio history, how it's been diversified across those key subcomponents over a period of time. And you see that since 2015, we've kind of hovered between the 5% and 6% level. And there are different times when we've had different asset allocation studies as to where we would bump up against 5 or move towards 7. I think the most recent one, asset allocation study, is where it defines our target weight for today. And you see that we've been relatively diversified across those buckets over time, with distressed credit being the smallest, given that we haven't had a lot of distress in our current market.
Ron, are you not seeing that, or are you just avoiding those?
I think we have a slide in here that really shows the distress environment has come down over time. I think different demarcations like the GFC, that's huge opportunity for us to be focused on distressed opportunities then. And then again, in the global or the COVID environment, we took advantage of things on a dislocation-oriented basis. But things have cleared up since then. Credit markets have normalized, and even in today's environment, there's not a lot of distress. And if you are involved in the distress, you better be on a very select basis, which we'll get a chance to talk about. The default environment is really sub 2% right now. If you include distressed exchanges, it goes a little bit higher, but that also is like an opportunity slash, something we're worried about in the marketplace. But Ming will get a chance to talk a little bit about that as we go forward. But great question, by the way.
Well, just in Charlotte, we've had 4 significant commercial properties get sold for substantially less than what there was invested.
Yes, sir. I think real estate is going on its own cycle relative to corporate credit, and I definitely believe that might be a bottom. I don't have a crystal ball, but definitely some of the dislocations seen in the real estate markets are piquing interest in terms of capital deployment and possibly signaling reasonable collateral, reasonable downside protection in that space. This current slide is also an oldie but goodie, but it really shows that over our 7% target allocation, we have been very focused on few managers. We have about 20 managers that we have about 37 funds with. So this highlights our ability to use our size, scale to our advantage, whether or not it's negotiating fees, whether or not it's being opportunistic, working with few, doing more with less, and things of that nature. So we'll move to the next slide. And I'm going to hand it over to Ming for him to talk about performance and portfolio structure.
Yes, thank you, Rob. So in the next few slides, I'm going to talk about the portfolio performance and also the characteristic of the portfolio. In this slide, the top graph shows the portfolio returns over different period of time, and the bottom shows the returns in calendar years. So similar to investment grade portfolio, that we really had a fantastic 1-year returns, double digit, 10%. And if you look at the bottom, it's really rare to actually for a credit portfolio to have a double-digit returns. Like over the past 12 years, there's only 1 year the benchmark had the double-digit returns. So this is quite unusual. We slightly underperformed the benchmark. I'll get into the reasons in the next slide on both 1 year and 3 year terms. But if you look at through the cycle and since the inception, the optimistic fixed income portfolio has meaningfully overperformed its benchmark. Since the inception, we consider it as a pretty clear, it's a pretty good credit cycle we have been gone through. The optimistic fixed income portfolio has returned 8.5% IRR since June 2009. When the portfolio was launched. And I recently run a study on that. It actually outperformed if we just simply put the money in the U.S. government bond ETF by about 640 basis points. So that's meaningfully overperformed the risk-free assets. As you can see in the bottom, year to date, actually, our portfolio has outperformed slightly. And then 2023, we actually perform on par with the benchmark. The reason that the 1 year has underperformed is because our benchmark has a pretty significant component of public traded securities. Can you turn to the next slide? So the next slide shows each subcomponent within our portfolio's performance, and also along with the benchmark. And one thing you can see stands out is high yield return of 15.7% in 1 year term. What happens is last year when we were presenting there's a distress in the high yield market, and then high yield market is highly volatile. As you can see, the 1 year return is 15.7%, but the 3 year returns for high yield is 3.1%. That just shows you how volatile the public market for these credit instruments, the high yield instruments is. But over the cycle, as you can see, each of the subcomponent of the portfolio have outperformed their benchmark quite meaningfully. And over time, we have been moving our portfolio away from public traded instruments more towards private credit, which we'll touch upon in the following slides. And that will help us to deliver more stable returns over the credit cycle versus traditionally, if we invest in credit, it depended on the public market and then it's highly volatile and it was not very attractive returns over a long period of time. Next slide shows the characteristic of our portfolio. So by strategy, we have a quarter of our portfolio is investing in special situation, a quarter in traditional corporate credits, and then 1/3 is in hedged fixed income, and then about 10% in distressed credit. We'll touch upon why distressed credit will have been lack of opportunities in the last few years in the later slides. By liquidity, well, we are credit investments, so we really don't have any level 1 funds. Most of our fund is in level 2, which is we can redeem within the next 12 months. And then 1/3 of the portfolio is in level 4, which means it's much longer, more illiquid investments. We think over time, we try to push more of the longer term illiquid investments, but we certainly keep in mind that we need to strike a balance here somewhere. By capital structure, by and far, we focus on downside protection, focus on safety. So 60%, almost 60% of portfolio is a senior secured loan, which means is the safest instruments that we can invest in our strategies. And then about 22.9% of the portfolio is in junior, and then remaining 17% is in equity. That's the results of the investment we made in some of the distressed situation and special situation where the debt was converted into equity. That still remain in the portfolio. By geography, by and large, we invest in the U.S. 84.7% is in North America, which essentially is U.S. And then the second largest geographic exposure is to Europe. It's about 8.57% of the portfolio. The remaining is relatively meaningless and minimal. Next slide.
Just one quick clarifying question. The traditional corporate credit you have shows up in level 2 because of the vehicle you own it in?
Because of the vehicle.
Because the vehicle, yes.
Thanks.
Next slide shows the characteristics of the portfolio by sectors. The largest sector we allocate to is financial. That's usually include a lot of mortgage bonds and that nature. The next two sectors followed by consumer discretionary and industrial. There's one large segment called others, it's 15.8%. That's just CLOs because they cannot be broke out clearly. So that was just aggregated into that, a structured credit. And Ron will talk about the market's condition we have seen for the past year in the next slides.
So last year when we were in front of you, the theme was higher for longer, it felt like. And we were wondering how would the global markets withstand interest rates potentially going higher. This year, we actually come to you with the opposite in mind. And then there are also some other key things about the market today. We're definitely in a very unique market environment in general when you take the totality of everything that is happening in the world. But with that being said, credit markets are functioning reasonably well. Banks are re-entering the marketplace as lenders. The credit crisis of, I'd say, 22, 23, when banks were worried about Silicon Valley Bank, et cetera, those things seemed to have normalized and come back into a normal place. Although the cost of capital has increased in recent years, companies in general are able to service their debt. And one unique market phenomenon that we're seeing that's a cause for concern, but also a cause of opportunity for us is what we're seeing is what we call LMEs or distressed exchanges. There are an increased number of distressed exchanges happening in the marketplace today. And some of our managers are actually taking advantage of the opportunity to proactively restructure and take advantage of things that they can negotiate in advance. I'm going to move to the next slide. This slide really shows 4 areas of emphasis for the portfolio. I'll take the top 2 first. Private credit is definitely a growth opportunity for the broader investor universe, but it's also been a place of emphasis for us in the last year or so. And actually even beyond, we actually started investing in private credit going back to 2007 when Craig and some of the private equity team members made a foray into that space. But in today's world, lenders are able to drive financing terms as banks have retreated the space. And even in a lower rate environment, yields remain fairly attractive. You know, if you're originating credit at SOFR plus 500, SOFR plus 700, that actually is a meaningful number approaching double-digit coupons, especially if you can avoid credit losses. So it's been a growth area for us. And then I'll look at the top right. In structured credit, the issuance in that market has been strong. On a relative basis, similarly rated structures are able to have excess spread relative to other high yield issuers. And then CMBS, RMBS, and ABS actually provide attractive yields relative to the underlying risk. And we'll get a chance to talk a little bit about that in Ming's section next. This is coming up. In the high yield market, spreads have compressed meaningfully. When we put this slide together at 9:30, spreads were about 300. And then this week or last week, spreads have compressed even to 260. So pretty quick move on spreads. But still, absolute current yields to maturity still remain somewhat attractive for long-term investors. Right now, for the high yield indexes are right at 7% yield to worst. And so that's not that bad if you're a long-term investor thinking about things. But one thing that we believe is the default rates are expected to increase, even though we're in a sub 2% default rate environment. For bonds and loans, we believe that default rates moving forward will increase, and impairments or recoveries may be lower moving forward. But with that being said, there's still opportunities in our space to deploy capital on a very select basis. I'm going to hand it over to Ming for him to talk a little bit about some of the macro things that are happening in our portfolio.
So when we look at our investments, we're making a lot of considerations. And Jeff has talked about how Fed made their decisions, so I'm not going to rehash much more here, but I just want to point out that easing cycle comes in waves. And Fed is one of the most influential within the global central bank's decision in terms of how they want to structure their rate cycles. And as you can see, that September this year, that when Fed cutting rates by 50 basis points, that started a global easing cycle. There's 26 rates cut globally by the central bank. And the last time we see this kind of spike is the COVID response to COVID in 2020. And then the time before that was response to the great financial crisis. So we think we are operating in a easing environment going forward, at least for the next couple of years. The next one, Jeff also touched about that, touched a lot about the monetary policy expectations. I just wanted to highlight that last year when I sit here, present to the committee for the first time, a lot of business is worried about this higher for longer rate environment because they may have trouble in terms of refinancing. So this chart just shows the implied Fed fund rates as implied by the futures market. So last year, as end of September, the Fed fund curve definitely shows the Fed fund rates is going to be pretty high, meaningfully staying above 5 for a long period of time. So the bottom, the blue line is what the future market is predicting the Fed funds rates right now. As you can see, there has been a meaningful shift that the market is pricing in about 50 to 75 basis point more of rate cuts in the next 18 months also. But overall, we'll say that the futures market is actually doing a pretty good job in terms of predicting where the Fed fund rate is going to be, as showing the dots in the middle, the gray dot in the middle is at the end of last September when I was presenting there, the market is predicting about 4.91 Fed funds rate as of the September Fed meeting. We actually achieved the 4.82 actual Fed fund rates at the end of September this year. So the futures market is pretty accurate in terms of 12 months out. But beyond that, it's going to start to diverge a bit more. As you can see in the bottom blue line, the Fed funds raise is going to be expected in July 2026, which is about 18 months out. So, and then the Fed funds will plateaus around 3%, which is considered as a neutral rate by the market right now. So we kind of operating under that kind of assumption in terms of how the business is going to react and then making their decisions in terms of how they want to finance their business. The next slide. So the decision behind that, here we just show what Federal Reserve in terms of predicting their economic growth and also inflation. Even though the market is very volatile, but if you look at this chart, if you squint your eyes very hard, it's actually, there's not a lot of change in terms of what Federal Reserve is expecting, where the economic growth is going to be and the inflation is going to be over the past 2 years also. And if you stare really hard, you can see there's a slightly upward slope to both charts. So basically, market is often talking about soft landing and inflation under control. Within the Federal Reserve's own forecast, it might seem to be that neither lending or inflation is a concern for them at the moment. Next slide. So under this environment where people are expecting rate cuts and also financial condition has eased quite meaningfully with record high stock market and record low credit spread, the bank has eased their lending standard quite meaningfully to both large business and small business. As you can see in this chart, we're almost back to the historical average. So bank is definitely lending, but at the same time, we haven't seen bank lending volumes because there are capital constraints and some of the regional banks still experience the problem from their commercial real estate holdings. So that's where in the void that comes in the rescuer. Next slide, please, where private credit has step into the void. And this chart just shows over the past decade that the tremendous growth that private credit has been able to take the traditional bank lending away from the banks. And as of the end of 2023, there's about 1.2 trillion private credit outstanding out there. And then we are seeing double-digit growth this year. And the forecast is going to be similarly for the next few years as well, as bank has retreating from their traditional lending space. And this is where we're going to take advantage of for our strategy. So given what I just said in the previous slide, last year when we said, rates going to stay higher for longer, a lot of business are concerned about refinancing their debt. And this chart just shows you that concern is probably not a real big issue for them. So for the past year, a lot of business was able to use the capital markets, all the private credit available in the market to refinance their debt. This just shows that the maturity wall of the U.S. senior loans have been extended by a couple of years now. We have seen loans made all the way to 2031. So the message here is the business has been okay in terms of dealing with the higher financing costs. So the next chart to basically just shows the distress opportunity because the combination of banks easing their lending standard and also the availability of private credit, the distress opportunity has meaningfully coming down. Here, the opportunity is defined as bonds trading, high yield bond trading over the 1,000 basis point spread, and then loans trading 80 cents, below 80 cents on the dollar. Right now, we're just about over $150 billion that is trading like that in the market. And the trend is going towards, it's going to be towards the pre-COVID kind of condition that sub $100 billion. So it's very difficult for us to source distress opportunities in the market right now. And then if we are in a lower rates environment and easing environment, definitely it's better to be in leveraged loan market rather than in the high yield market. As you can see that this chart just shows the hypothetical projection in terms of companies that utilize leveraged loan market or utilize high yield. So companies that finance themselves through floating rates loans will benefit from Fed cutting rates in the next 18 months as their coupon will come down and then their coverage ratio will improve versus high yield issuers because they have financed themselves in fixed coupons. So their interest rate payment won't improve that much and their coverage ratio is going to deteriorate over time. So we definitely keep that dynamic in mind when we're making decisions in terms of how we want to invest our portfolio going forward. The next slide just shows interest rate coverage. We probably have reached the trough, and similarly, cash coverage ratio have probably reached the trough because the rate environment has changed. We have been going forward. I think a lot of business will be very happy as their interest expense burden is going to be lessened over time. Ron, you want to take over the spreads?
Okay. It's kind of what does all this mean? On the more liquid side of our portfolio, on a relative basis, spreads are pretty tight. Again, as I said, when this chart was presented, what we put together was the spreads were at 303, and then they've moved to 260. So on a relative basis, not necessarily adding a lot of value relative to other options, but on an absolute basis, our liquid portfolio still has, next slide, on an absolute basis, the index is still providing close to 7% yields to maturity. Doesn't really give us a lot of upside from here, but as long as managers are able to find good credits and avoid losses, that's what you pretty much expect to earn in our more liquid portfolio. So as it turns out, our more recent recommendations to the treasurer have been more in the more private credit space. We're able to actually earn excess yields relative to this, and we think that we're going to take similar or less risk as well in that space. Next slide. This is a culmination of multiple instruments that one could invest in. It also is saying the same thing. Credit spreads are near recent lows across different investment categories. And the range goes from 2019 to 2024. But if you look at the green lines, the green diamonds, you'll see that the green diamonds are typically on the left-hand side of everything. So we're on the lower end of the spread range since 2019. One exception is in the real estate space, where you're kind of in the middle of the space there and other ABS opportunities. And then if we had private credit listed here, you'd see private credit on the higher end of things, still at 400 to 600 over based on the individual issuer. Next slide. Last year, when we were here, we were showing you the opportunities in orange. We were pretty excited about all the things in orange. We were still saying, hey, yes, it's a great time to continue adding to our space, categorically speaking. And then this year, if you look at the blue and green, you see that everything has moved in meaningfully from last year to now on a yield to maturity basis. But the things in green are the strike zone of where we continue to believe that incremental capital may still be value added for us on a go-forward basis, on a return basis, especially if we can find managers and work with managers that are able to avoid credit losses. So we're still seeing on a blended basis, the things in green, looking at double-digit, high single-digit yields to maturity. And those are where our recommendations have been this past year. And if anything gets done between now and year end, those would be places where our recommendations would be for marginal dollars of capital. Next slide. CMBS spreads are anomaly relative to everything else. It's still above its long-term traditional average of 576. We're still in the 700 over space. That's also an area of opportunity for a select of our managers that are able to take advantage. You're seeing our books meaningfully lean into that space and looking at opportunities where there's very little downside risk, where managers are actually allocating to some of these assets in the space. So that's where our marginal dollars will also be on a go-forward basis. Wishfully thinking. And then, as it pertains to the default environment, we're in a very low default environment. As you can see by this chart, we're in a sub 1.5% default environment. But on the right-hand side, if you look at the distressed exchanges, as implied by PitchBook, it's actually a little bit closer to 4%. So we're not necessarily blindly taking risk in this space. We wanted to work with managers who have the ability to roll up their sleeves, be proactive in restructurings, and actually take advantage of some of the LME opportunities that exist. And that's where we see in some of our co-investments where we've really shined, where we, on a one-off basis, have been able to work with the manager, work with the illiquid opportunity, and really drive terms in effect. Same story over again. Next slide. What does all this mean for us right now? Potential headwinds, global conflicts abound. There's a lack of distressed opportunities with attractive spreads. There's a potential for increasing default rates, and then potential for lower recoveries for defaulting issuers. If you really dig into the LMEs, second-time LMEs or folks that are due Chapter 22s, you see the recovery rates for second times a whole lot lower on a go-forward basis. Next slide. Tailwinds, things that we think that are really helping our space right now. The banks are capital constrained. Traditional lenders are exiting the space, which gives us an ability to originate loans with reasonable financial covenants. And we have a very strong manager lineup that has shown the ability to pivot as opportunities evolve. Final slide. Moving forward, we think that we should cautiously, underline the word cautiously, take advantage of the elevated yield environment with our best-in-class managers. We want to maintain meaningful exposure to senior secured debt. Again, we really care about capital preservation. And then we want to continue to focus on our SMAs and special situations. If you look at our performance, one of the areas where we've been able to shine is in our special situations book, where the realized returns on a long-term basis in that subcategory are really attractive. And then we want to continue exploring real estate debt as a way to deploy marginal dollars of capital. And then one thing I really want to highlight with working with the treasurer here, we've been able to focus a lot on dislocation mandates. So when spreads have blown out, we were able to allocate a significant amount of capital. Even when during COVID in particular, between March 17th and April 4th, Treasury, we were able to allocate marginal dollars of $600 million or more in some of the worst time periods, because we were really focused on dislocation mandates. And as spreads have come in, a lot of our dislocation mandates have wound down and come off the portfolio. But, as spreads are tight, we really want to kind of reset and revisit those and make sure that when and if spreads ever rise to 700 over, 600 over, that we're there to take advantage of those with very little time delay from the moment in which spreads are widening and our ability to deploy capital into those things. So those would be our portfolio priorities in my mind on a hopeful basis as we move forward.
You don't think legal fan that?
Oh, legal's been great and helping us achieve a lot of these things. And so that's one thing is legal documents take forever to get done. And so things that we can do and be proactive in advance, that has always been helpful. It's something that we've tried to strive towards. Thank you, Jason, as well for and just everybody, Treasurer, Jeff, Chris, et cetera. Thank you for being as well for helping us be able to execute and deliver on the mandate that we put forth in front of you.
Thank you. Any questions? Good job.
Thank you.
Thank you for that presentation, Ron and Amelia. We'll now call on our public comment section. Did anyone sign up for public comment? Hearing none, I'll hereby declare the public comment section closed. We'll go around the horn and give folks an opportunity to say something. This is a lot of the IAC members who've served this board for a long period of time. This will be their last meeting, as it will mine. So we'll give them an opportunity just to say something, and we'll go to Mike first.
Hold on, I had to get my mute off. Are you there?
Yes.
Well, I guess my initial question is, can I call you Dale now, or are you still going to be Mr. Treasurer?
Just call me for dinner.
But so Dale, I just want to express how important, I guess, John, we've been doing this for 12 years, or what's the number?
11.
11.
Feels like 12.
We couldn't quite get that 12th year, could we? So, but it has been a joy working with your staff, meeting them for dinners as we came into town, spending time with people as people, not only as presenters. And I try over the years, I try to ask a lot of questions because you guys worked really hard on these presentations. And I just love, challenging you on what you presented, and in each case, you guys met the challenge. Looking back on the activities, I remember the asset studies that we reset. I remember the effort to reduce costs, because you taught us all that reducing costs is the same thing as increasing income. So just appreciate all of you guys, and we'll keep in mind when I'm in Raleigh that you might hear from me. Thank you, guys.
Thank you, Mike. Greg?
As I sit here today, I'm thinking back on all the years I have had meetings in this room, both in being fortunate to serve on the various pension boards and the IAC board. And two things I'm reminded of, Treasurer, and the first is the importance of making decisions based on facts and based on math, not on emotions and not on optics. And you have led the charge on that. And second thing that I'm reminded of sitting here today is that we can be in disagreement, but that does not mean we're disrespectful. So this term has been used a little too much, but I think it's appropriate. Thank you for being the adult in the room for so many occasions over the years. I will be back in the yoga studio. I will be calling you Dale in the yoga studio when you're doing your handstand. Thank you.
And Greg, our thoughts and prayers are with you.
Thank you.
And we look forward to having you back in the studio. It's a great, what happens in the studio stays in the studio.
That's creepy.
Well, I'm sure it is in South Carolina, but it's not Springfield over the So, yeah, we have a great community of men. About 45% of our participants are men. And you can have a conversation about the Tyson fight or an amicus brief, and all in the same 2-minute section of that's just the type of people that practice there, that have all kinds of backgrounds and lives and meanings. So we look forward to having you back.
Wow, I'm so excited today. I touched my toes. I look over and you're doing a handstand. So it's like, oh.
Yep. For as long as we can, anyway.
That's right.
I'll be doing that at the Charlotte Hornets game on the 30th of December at halftime, and February something at the High Point basketball game. So I'm the full-time North Carolina assistant to the amazing Slottick, who's the oldest daredevil in the world. If you've ever seen his presentation of stacking chairs and then doing a headstand 26 feet up, I hand him the chairs. The chairs are not connected. Jeff,
That's correct. That's crazy too.
Pretty identifying. When we were in Reynolds Auditorium last year, when he did his headstand at the top of the stack of chairs, his feet were almost touching the scoreboard of the old auditorium. That's how high that is. And I won't say too much more about this, except this is not something you practice. You just do it, because when he does it, and that's it. And but he failed to tell me that at the top, then, because I hand the chairs to him on a pole generally at the last. But he did not tell me he's going to throw them back at me as he comes back down. So I learned that the hard way on the first performance, but now I know the chairs are crazy. Because he can't look down. When he looks down, he falls. So he just does that, and I'm supposed to catch him from that high. So, but anyway, thank you, and thank you for blessings and prayers.
Thank you.
I'm going to go to John next, and we'll go back to Lars. John.
Well, so yeah, 11 years. And when I was talking to Sam, it reminded me, he became a dad 11 years ago. And how many of those stories that I know of the people in this room. So not only were they professional all the time, but we also had some great friendships, or have some great friendships. Know a lot about a lot of families, obviously, who's a Wolfpack fan, who's a Carolina fan, all that kind of stuff. And so I've really enjoyed my time here, and I always feel like I'm smarter when I leave than when I came in. So I appreciate everybody's efforts.
Morris?
Well, I, like Greg and John, have been serving on the trustee boards and this advisory committee for a number of years. I have really appreciated the talent and the dedication of the staff. And I feel like the benefits of the state and local government retirees are secure in the future. We've got it laid out for you to just continue.
That's it off the Treasurer-elect Briner, then I'll say a closing. Well, let me say, forgiveness about Lars. We talk about courage, we talk about vision, and when you to office after 20 years, you find things. And 34 years ago, I guess, Lars Coakley is the Chief Financial Officer for the City of Winston-Salem. We first met because I was on the Citizen Advisory Board, where as a conservative, I recommended spending more money. It's not normally a thing you're associated with that, because we had determined that if you assign a police vehicle to every police officer, the police cars last longer and you lose less shift time in transferring the stuff from one car to the other 2 times a day. So that's where I first met Lars. But all those decades ago, he started looking at the unfunded liability of the city of Winston-Salem for its unfunded healthcare liability. And he started it. He was the first county or city in North Carolina he started actually got this city council to put money toward this invisible thing out there that no one ever thought about. And I don't know if you've seen these numbers lately, but since he did this, Mayor Van Root, City Council of Charlotte picked up on it. But this is almost unbelievable what I'm getting ready to tell you mathematically. So the city of Winston-Salem has a $67 million OPEB liability. Because of his courage and his foresight, they have $71 million in the bank. It is 105% funded. Now, if I were there, I'd probably try to find a AAA insurance company to defease that and be done. What I would do. But that's their decision. But I say that because that was his courage and his vision and the courage of this city council and the current city council to take advantage of this liability. I mean, to take responsibility for it. It is a debt. Lars, like many others who are trained the way we are, know that if something is estimable and probable, it is a debt. And I say that because the biggest offender of this issue is the state of North Carolina itself. When I first came in, whereas the city of Winston-Salem plans 105% funded. When I first became the treasurer, our plan was 2% funded. We're not talking about 67 million. We're talking about 34 billion, bigger than the state budget. So now we're up to about 9% funded. It's getting ready to go back down again, in my opinion. So my point is that I wish the city of Winston-Salem, I wish the state of North Carolina would have had the vision and the foresight to do what you did for the city of Winston-Salem and the taxpayers and making sure that this is not an unfunded liability. So I wanted to congratulate you. Lastly, when you're cleaning out your office, this is my first IAC meeting where the plan was valued at $90 billion. And I'd say since then, in gross benefits, sorry, Christopher, I like to talk about gross benefits. More dramatic. But we paid out $50 billion in gross benefits in 8 years, I believe, $50 billion, and the plan's not 127. So anyway, that's a credit to all the staff that you see sitting in front of you. Lastly, I've enjoyed these meetings. This is just like Treasurer-elect Briner. These are a lot of the things that the state treasurer has to do is not exactly in their wheelhouse as they come into this position, but this committee is. It was for me as a former employee of Alex Brown and the vast investment experience. So I just wanted to thank all of you, all of the staff, and I think our responsiveness, I was a little disappointed about the co-investment stuff because I don't know of any state that can turn things around as quickly as we can. But I mean, when they have an idea, they take it to the co-CIOs and they get it to legal, and then legal starts working on it, and then we can respond very quickly. And that has resulted in some very big returns for us. As I leave this committee for my last time, I just want to thank everybody for advocating for the invisible. Some of you have heard this before, but it bears repeating. I define the invisible as those that don't have enough money to have political influence. And I'm sad to say that. They make a little too much money to get help from time to time in their life. And they work 1 or 2 jobs, maybe 3, to pay their taxes and pray for a better outcome in their life. There's nearly 1 million people on the pension plan now, 1 out of 10 adult North Carolinians. Some of them know who I am. Some of them know who Representative Treasurer-elect Briner is. Some of them know a little bit about asset allocations and those kinds of things, but it's not important that they know who we are. It's important that we know who they are. and to always advocate for them, and to always keep in mind that what fiduciary really means, which is now, I guess, nearly 400 years old, that word is. Never put anybody ahead of your customer. And our customers are those that teach, protect, and serve, who are not only represented by the people in this room as employees, but also their parents, and in some instances their grandparents, who participate in this plan. So thank you for continuing to advocate for the invisible, and not being afraid to challenge assumptions and ask the right questions. I suspect when Treasurer Moore went through 9/11, as soon as he got elected, sorry to lay this on you, but and the plan lost billions of dollars through no fault of Treasurer Moore. As soon as Treasurer Kyle was elected, she was hit with a great financial crisis. Somewhere during my tenure, we were hit with the COVID, where the markets were down 20 and 30% in 2022. So hopefully you'll break that cycle. But anyway, I just wish you the very best, and I'm glad that this team had an opportunity to present to you today. And we got Vanna over here. So just got to get a smile out of them once a day. But also the great staff back here who makes everything jump up on the table. So we are going to adjourn in honor of all of our members who are this will be the last meeting, but we'll give Treasurer-elect Brown an opportunity to say a few words.
Thank you. As everybody knows, I have enormous shoes to fill. And I thank you, Treasurer Fall, for so many things. A couple of things came up today that are just so noteworthy, and you all know them and you lived through them, but coming into this office for the first time and observing them, the courage to address the assumed rate of return is truly rare. Most people with problems of that magnitude like to punt them to somebody else. And you and your team address those head on and leave this plan in such better shape for it. You also leave me with an amazing team. And we got to see that again today, and I'm super excited to work with all of you guys. And thank you all for the role you played in making sure that this plan is where it should be. And that's in the top quartile of best funded plans in this country. The state that's generally well managed, except for the state health plan reserves. And that is a credit to all of you for your service to this state and where I find myself coming in here. I sincerely hope that I do not have something around the corner that we can't foresee. But I'm confident that with this team and everything that you've left us, we will deal with that if it comes. So thank you.
Thank you. With that, and also want to thank my assistant, Annie Gaunt. This is her last full week. I told this story, but I like telling it again because as many of you know who know how I roll, she is the glue. She's the glue for every aspect of my life because you can't have different people scheduling you. And so I say that because the former EA, she left when she retired when Treasurer Cowell retired. And HR had a whole line of people lined up to interview. And Anna worked with the previous administration, and she had just lost her job. I didn't know any of this till after the fact. Tell you just how remarkably poised she is, as young as she is now, and even was then 8 years ago. She came in and we were interviewing, and I said, "Do you know anything about this office?" And she said, "No." And I said, "Do you know anything about me?" Which is even more difficult. And she said, "No." And I said, "So you don't know anything about the office, and you don't know anything about me. What makes you think you can handle this?" And she said, "I have a father, 2 brothers, a husband, and a male dog. I don't think you're going to be any problem at all." That was pretty quick. And we hired her on the spot. And she's been amazing. She's probably not listening right now, but just like the people in our call center right next door, Treasurer-elect, she answers her phone. And we're probably one of the only state agencies we answer our phones. So people call us for all kinds of issues that really don't belong in our department at all. So I just want to applaud her in the last week, in her last full week, as she goes on to new adventures and shepherding us through my near-death experience with COVID. Since she's been here, her husband Evan have had 2 children, and she is represents what a lot of women in our state do, and a lot of our state employees do. They juggle and they manage, and they're the glue that keeps households together and finances together and families together. So I not only applaud all of our board members, our staff, but also want to say something about the role she's played in filling this, because sitting on as many boards as we sit on, things can get tight as far as having to be 2 places at one time. And when she was first started, and the last little story, she just first started, she said, well, they want to know when. I said, you guys, as many boards as we have, with as many people as are on these particular boards, just have them set the meetings and we'll deal with it. And that's basically what we've done to the best of our ability. So with that, thank you all for your participation, and in honor of Mike Bevan and John Anarella and Loris Coakley and Greg Patterson. You're not conflicted by voting on this, by the way. I'd like for somebody to make a motion. I'll make a motion that we adjourn in honor of our IEC board members.
So resolution, appreciation of service.
Okay. Thank you. In our board book, we have resolutions and appreciations of service for all those that I previously mentioned, and we'll be, since we watched the pennies of the paper clips, we're going to be handing those back to you today, so we don't have to stamp on them. Those are the resolutions that'll be a part of our minutes. Is that satisfactory?
Yes, sir.
Okay, thank you. With that, motion to adjourn, second?
Second.
Well, how about a collective second? See how your harmony is.
Second.
All those in favor will say aye.
Aye.
Opposed, no. And we're hereby adjourned. Thank you very much.
Bye, everybody. Thank you.